we continue to think that this is an environment of transformation rather than an environment of your typical cycle.
Rates are still meaningfully above neutral.
Not only do you have fixed income concerns, but in equities, they're very expensive from a valuation point of view.
You still have those winners and losers, but I would say that there's more winners than losers these days.
We think you're set up for another double-digit return for next year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City for our audience worldwide. Good morning, good morning. Bloomberg Surveillance starts right now, coming into Thursday on a 4-day winning streak on the S&P 500 after printing another series of all-time highs. Your equity market shaping up as follows. Futures lower by almost 0.1% on the S&P. On the Nasdaq 100, we're down by 0.15. Going into this morning with tons of economic data, 8:30 Eastern Time. Jobless claims in America. Then Lisa, tomorrow, the big one. The estimate in our survey, around 215. The high is 275. The low is 155.
At this point, I think a lot of people are looking at good news being good news as long as we don't have some sort of torpedoing of rate cutting expectations. And even with some hawkish talk from Fed Chair Jay Powell yesterday, some people might say it's hawkish, some people might say it wasn't overwhelmingly dovish. There was this feeling that rate cuts could continue because the strength that we're seeing in the labor market is not coming in tandem with inflation. That is the feeling, at least right now.
Listening to Chairman Powell seems to have confidence in the direction the committee is going in. Cutting interest rates, questioning the pace. And we've talked about this a few times. We heard from Chairman Powell a few times in the summer, but two stuck out. Once in Sintra, Portugal, the other in Jackson Hole. In Jackson Hole, very worried about unemployment and a softer labour market. In Sintra, Portugal, at the start of the summer, he talked about a strong economy and that strong economy giving them time to get things right. And that's the Chairman Powell we heard from yesterday.
This was a Chairman Powell basically reading between the lines. Okay, and people can write in and tell me that I'm wrong, but this is how I heard him. Basically, we're probably going to cut next month, but don't expect us to cut again for quite a while in 2025. And that seems to be the gravitational force, saying we can afford to be a little more cautious as we try to find neutral. It's been pretty much the broad-based consensus right now on the Fed.
That cut might still be dependent on the incoming data. Friday, tomorrow morning, payrolls. Next week's CPI, December 18th, the Federal Reserve. Got to talk about some price action elsewhere as well. Bitcoin cleanly through 100K, up on the session by close to 5%. We are all looking at the selection of President-elect Donald Trump for the SEC.
Yeah, that's right. This is giving that extra oomph to the Bitcoin price that you have and also to the crypto community. He's tapping Paul Atkins, someone who actually ran the SEC as well, a Republican. And basically, it's just suggesting 4 years of a very light touch when it comes to the likes of crypto firms or hedge funds. So the crypto community, as well as others on Wall Street, have been welcoming this individual, especially since a lot of people in the financial community, in the crypto world, even Democrats were saying they really did not like Gary Gensler, and they're happy to say goodbye to him.
I love this because one of the commentators from people in the crypto sphere said this: the nomination of Paul Atkins as SEC chair just added to the carnival atmosphere. I mean, let's just put it into perspective. We have risen 50% in Bitcoin since Donald Trump was elected president. This has been a moonshot. And basically, who's going to get ahead of this momentum trade, given the fact that people seem amenable to some sort of framework for crypto?
Anyone but Gensler seems to be the takeaway for the crypto community. Bitcoin's up this morning by close to 5%. Coming up this hour, we'll catch up with Max Kettner of HSBC, remaining bullish on equities. We'll speak to Simon French of Panmure Gordon as France's government collapses, and Sonia Meskin of UBS ahead of the latest payrolls report. We begin this hour with the S&P 500 on course for its best year since 2019 after posting its 56th record close of 2024. The team over at HSBC looking for the rally to continue. Heading into 2025, we maintain a risk-on stance in our tactical asset allocation. We think the outlook could easily resemble a 2017-style Goldilocks backdrop. Max Kettner joins us now for more. Max, welcome to the programme, buddy. It's good to see you, as always. You are looking for a, quote, powerful rally. Can we put some numbers on that, please?
Yeah, I think particularly in H1, I think that is going to be really, really powerful. So we're still going to be overweight equities, particularly US. But really, across the equity spectrum, the most bearish you can get is maybe neutral on a sector and on a region. But honestly, when you look at the numbers, I think, you could easily see some sort of 5 to 10% up in the first 6 months, because just the policy backdrop that we've got with continued rate cuts, with, the Fed already starting to hint perhaps at some sort of discussion around an end of QT in last week's Fed minutes. And then all these sorts of things on the regulation side, it's either going to be the same or less. On the fiscal side, it's either going to be same fiscal spending or more fiscal spending. Taxes, either going to be the same or less taxes. And then, we obviously had these revisions to the national accounts 2 months ago where real disposable income of US households has been revised higher by almost $1 trillion. So just putting some numbers on, we've been talking about how under the hood the US consumer is doing much less well than we all thought, whereas now in reality it looks like actually real disposable income has been around 800 billion higher than the first estimate. That ought to be good, particularly with election-related uncertainty really subsiding now. I really can see that consensus, which is still calling for around about a deceleration of US GDP growth to around potential 1.7, 1.8 in the first half. I think that's way too bearish, and that means earnings expectations also too bearish. That really, it's such an extremely supportive Goldilocks backdrop.
Max, you said it a few times. In the first half, in the first 6 months, what is it about the second half that you're not committed to?
Yeah, I think I'm just too stupid to look further than 6 months, to be honest, right? But if we're honest, in the second 6 months, there's a couple of things that could really be upsetting markets. We could start to get to the end to the cutting cycle, right? And then we're talking about, what's the neutral rate? Is it maybe perhaps actually really a bit higher than we thought? That could be upsetting markets. We've got to deal with the 2017 tax cuts. Are they really going to be extended? Are they all going to be extended? Is it only half of them? What proportion? Which one is it? Is it the income taxes? Is it the corporate tax cuts? So those kind of discussions that we may have towards the second half of the year, that really, I think, it has a bit potential to at least temporarily upset markets, whereas the next 6-8 months, I think is super, super supportive.
The difference between this type of Goldilocks, Max, is that it's not supporting the rest of the world. In fact, it's happening in a vacuum. The U.S. is sort of in this extreme Goldilocks, extreme bullishness, while everyone else looks terrible. And how long can that continue?
Well, Lisa, you say that, right? Like everyone else looks terrible. But when we look, for example, at Europe, I mean, a week ago, would you have gone long Europe? Had you known what's happening in Europe now, would you have gone long European equities, long European credit, even the Euros rallied? So to be honest, I think there is a potential, even in the first half, where if we start to see the US accelerating, and I 100% agree with you that this is a very US-centric Goldilocks backdrop from a macro, from a growth and an inflation perspective, but I think there is also a basis for that to actually spread towards other asset classes and other regions. I do think if we start to see things like super core inflation start to trend down in the first half, because we had these very high readings, for example, in the first quarter this year, there is a potential for that perhaps really starting to go down a little bit in the first quarter, in the first 4 months really of this year. And that would be, that would introduce a Goldilocks backdrop that can even perhaps extend to something like emerging markets, even emerging market rates. Look, for example, at the moment at emerging market credit. You would think that, emerging market credit would be much more challenged. The reality is, you look at EM credit spreads, they've been going down below 300 for the first time in about 2 years. They're really going towards the tights again. So I think, yes, from a macro, from a growth, from an inflation backdrop, very US-centric, but we're already starting to see that actually extend to other asset classes, to other regions and sectors.
Max, the extreme bullishness seems to all be predicated on the idea of ongoing disinflation. We have this idea that inflation, the beast has been killed, that basically rates are restrictive. We heard that from Fed Chair Jay Powell, even though he does think that he could afford to be more patient with the pace of rate cuts. What happens if they're wrong? Is there sort of a sign, maybe from ISM services yesterday with prices paid actually increasing? And you get this feeling that investors and companies are reinvesting in their businesses. At what point can we really be confident that inflation has been slayed?
Look, I think 3 months ago, Lisa, I would have agreed with you. 3 months ago, you saw 2-year break-evens at around 160. You saw a 1-year inflation swap around 170. You saw the monthly fixings for February, March, April clearly below 2%, actually approaching sort of 1.5% on the year-over-year rate. That was the time when pretty much everyone declared inflation dead, including what you guys have just been talking about, Jackson Hole, where Jackson Hole has been saying, we're no longer really worried about inflation. It's the labor market that we're now worried about. So I think 3 months ago, I would have agreed with you. But what we've seen now, obviously, in the last 2-3 months is this massive repricing of particularly short-end inflation expectations. So what I would argue is, yes, there may be some inflation coming back, but it is now really in the price. Very contrary to 2-3 months ago, where, it's been almost the other extreme. Now we're approaching the highs in front-end inflation expectations that we've last seen in April, when the swaptions market was pricing an almost third possibility of another rate hike by the Fed. That's how extreme we've now become. So I would say, particularly from a pricing perspective, a lot is now in the price, a lot has been repriced, and particularly from sort of an outright inflation perspective, you look at the first 4 months, always bear in mind, on the super core side, this year we had a 0.5, a 0.7, and a 0.9% month on month in the first 3 months of the super core, of this most narrow underlying inflation measure of the Fed. If that doesn't repeat or even exceed it in the first 3 months of Q1 of 2025, that should create a bit of disinflation and underlying inflation measures, and that should give the Fed more comfort to cut rates. And again, better growth with decelerating underlying inflation. How much more Goldilocks can it become?
Max, though, you do say inflationary risk can come from tariffs and geopolitics in your note, where you say what can go wrong in 2025. But you also talk about the fact that you think potential tariffs might be less than expected. Why do you come to that conclusion?
Yeah, look, I think we've got to wait for, what's actually beyond sort of the narratives and the daily tweets. We've got to wait really what comes more concrete, what comes out of it. That's the first thing. The second thing is, why do we need to wait for that? Because the Fed has clearly been saying, we're not in the business of speculating. We're not in the business of, maybe they'll do that, maybe we'll do that. They are clearly in the business of, okay, we'll wait for the policy measures, we'll wait for the proposals. Once they're implemented, then we'll do our analysis, and then we react. From a market perspective, from a financial market perspective, that's the much more important thing. It's not so important what's going to happen really on tariffs. Is it going to be A or B? What's much more important is, how will it change the policy setup? So I keep banging on about it, that it's not the day-to-day politics. It's the policy setup that is much, much more crucial. And again, that is probably something more likely going to happen in the second half, not in the first half. And we've got to, like I said, right, we've got to wait what is definitively coming out of that, not only for us, not to get too fixated on the 50-50 day-to-day politics, but also in order to really, really then assess how is it going to affect the policy setup. That's not something for the next 6 months.
Max, we're all in the business of speculating, sir, and we'll do just that. Max Kettner of HSBC, thank you. What we can do, and I think we are in the business of doing, is identifying potential points of tension. And I think you can do that at the moment. If you take the really optimistic, constructive view for 2025, I think a point of tension is the difference between that and potential sequencing coming from Washington, D.C. Anne-Marie, I think we just got a better feel for it this week. The taxes might just have to wait. So if you were worried about maybe not getting the good stuff for a while, that's what we're hearing from Washington, D.C. And what you hear from President-elect Donald Trump is he's ready to go day one on tariffs. Day one on tariffs. And I'm not sure just yet that they're ready to go on day one when it comes to taxes.
Well, they're not. We heard that from at least Senator Thune, who's going to be the majority leader, talking about they want to go with immigration first, the first 100 days. So taxes means maybe mid-2025. And then when it comes to day one, we have more insight on what tariffs and what that discussion might look like. Why? Personnel is policy. Guess who's back in the West Wing? Peter Navarro. It's going to be Peter Navarro, Howard Lutnick at the Commerce Secretary, and Jamieson Greer at USTR versus someone like Scott Bessent and Kevin Hassett in terms of how they're going to implement policy when it comes to tariffs, blanket or negotiating tools.
They are ready to hit the ground running and deliver tariffs. Equity futures right now on the S&P just a little bit softer, with an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. President Emmanuel Macron is searching for a new prime minister after a no-confidence vote against his government was passed, ousting Michel Barnier. Macron needs to find a premier who can pass a 2025 budget through a deeply divided parliament. Barnier was only appointed in September, making it the shortest tenure for any premier since 1958. Macron is expected to speak at 8 p.m. Paris time. Bitcoin has touched $100,000 for the first time, getting a boost from Donald Trump's pick to lead the SEC. Crypto proponent Paul Adkins will replace Gary Gensler, whose focus on crypto crackdowns and stock trading regulations had drawn resistance from Wall Street. The overall crypto market has surged by $1.4 trillion since Trump won the election on hopes that his administration will support the digital asset industry. Shares of American Eagle plunging this morning 16.5% pre-market. It issued a week holiday guidance, cut its annual sales outlook for the full year. American Eagle also reported sales, which dropped about 1% from a year earlier. The company's CEO said that there was strong back-to-school demand, but otherwise choppiness and pullbacks in between those key periods. That's your brief. John.
Danny, thank you. Retail is brutal right now. If you miss, you get punished big time.
There's a real question about whether you're cool, whether you can actually manage through an influencer time of, product drops and different types of social media influence. And if you can't, well, the hammer drops.
Dollar General reporting a little bit later this hour. We'll hear from Kroger later this morning as well. Up next on the program, the French government collapses.
Marine Le Pen, I think, has decided that it's better to precipitate a crisis than to have a weak government. She probably thinks that accelerating the agenda, the political agenda, is what is best for her at the moment.
That conversation up next, live from New York City this morning. Good morning. Equity futures right now in the S&P 500, negative by 0.06%. A sprinkle of data, some earnings as well. Look out for jobless claims at 8:30 Eastern Time and some retail earnings reports through the next couple of hours. We'll hear from Dollar General and from Kroger. It's time now to focus on the politics. Under surveillance this morning, the French government collapses.
Marine Le Pen, I think, has decided that it's better to precipitate a crisis than to have a weak government. I mean, the calculation of Barnier was that Marine Le Pen wanted to polish her image. She probably thinks that accelerating the agenda, the political agenda, trying to go after Macron is what is best for her at the moment. And that's also the view of the extreme left.
So here's the latest this morning. The French government of Michel Barnier toppling after just 3 months in power following a no-confidence vote, marking the shortest tenure for a French Prime Minister since 1958. Joining us now from Paris for more is Bloomberg's Kriti Gupta. Kriti, good morning to you. What is the latest in Paris this morning?
Good morning, John. Well, Michel Barnier is out. Emmanuel Macron is in the spotlight. Yet it's Marine Le Pen who is all over the French newspapers this morning. The idea that Emmanuel Macron now has to solve the puzzle of which caretaker prime minister, potentially his eighth, can survive a no-confidence vote from Marine Le Pen, while also battling resignation calls from the far left as well. The trick here is what happens to the budget, because that's really where the sticking point is. A budget that does not increase a deficit. And really what this means, and the most likely outcome here, will be a technocratic government in France, one that rolls over the 2024 budget into 2025 and creates potentially inflationary costs for French consumers, increases taxes for a lot of French households, but then potentially, because of the austerity baked into it, decreases some of the deficit concerns as well. And that's what's reflected in the markets this morning, John.
Kriti, appreciate your time. Fantastic reporting over the last few days. Kriti Gupta there out of Paris, France. Simon French joins us now of Panmure Gordon. Simon, good morning to you. We clearly have a political crisis, chaos in the government, if you listen to the reporting coming from Kriti this morning. Simon, how close are we to having an economic, a financial crisis?
We're a fair distance away. I think the playbook, at least from the ECB's standpoint, is pretty clear at this point. It has its transmission protection instrument put in place a couple of years ago. I expect ECB policymakers over the next few days, if yields, which are currently on the 10-year, about 85 basis points higher in France than they are in Germany. That's about double their 5-year average. That's not a stress point yet that requires direct intervention. And ECB policymakers, to try and avert that aforementioned economic crisis, will try and have some self-fulfilling commentary saying we got the toolkit, it's there, we'll intervene, we'll change the purchase ratio if required to try and keep a lid on yields. And to be honest, the market reaction this morning is pretty underwhelming, suggesting that even without the commentary, is where market participants expect things to go.
That said, Simon, it might not necessarily be some sort of immediate financial crisis getting baked into markets, but the slow bleed of not having leadership potentially for months to come, with questions over the president himself and whether he is going to resign. At what point does that weigh not only on French assets, but on the euro? As it's not the only region facing this political instability, it's also Germany.
Yeah, it's not without, well, I was going to say friends in terms of economic and political turbulence going hand in hand. I think you're right to say that, even the instability, even the uncertainty has economic implications. And while actually, first order, the impact on GDP of a less restrictive budget that was planned by Michel Barnier's government is actually going to be accretive in terms of government spending, and the size of the deficit expected to be about probably 100 basis points higher, 6% of GDP next year as a result of this budget not passing. I think it is the private sector impact on investment, consumption, business and consumer sentiment that is a bigger headwind than that is a tailwind. So you can see OECD, our own expectations of a growth of only 1% anyway in France next year. I think the downside risks in recent days have just grown to that number.
To build on that, at one point, Paris was thought to be the alternative to London as sort of the financial center after Brexit. And there was this feeling, look, we have the stability that Britain right now doesn't because of potentially separating itself from the rest of Europe. Has it just lost that completely, that upper hand, as they face political instability and a real pushback against some of that structure?
Yeah, I mean, I never... Personal view, although Brexit was very much a self-inflicted negative for London, and while there was some analysis around the total market cap of the French stock market briefly exceeding on a couple of occasions the UK stock market, I don't think it ever had that structural advantage. But you're absolutely right. Emmanuel Macron has been on a pretty big charm offensive to try and get finance sector jobs away from London to France. This makes that job for the residual time of his presidency even harder.
Simon, a French official quipped to me yesterday that we are seeing the Italianization of French politics. And I'm not sure if that's rude to the Italians or the French. But my question for you is, we're dealing with two core economies in the Eurozone that are dealing with political instability. Do you have concern that this could be maybe contagion to the rest of Europe and in the periphery?
Well, I don't think there'll be too many people, certainly not in Marine Le Pen or Jean-Luc Mélenchon's part of the French Parliament, who'd be worried about, dare I say it, an Italianization if it reflects in borrowing costs, because actually spreads, we've talked about earlier in this clip about the expansion between German and French spreads, but actually we've seen a spread narrowing under Meloni and the Italian government. But I think you are right that stepping back from perhaps the slightly artificial spread environment driven a lot by sort of ECB sentiment, the broader economic picture of, I was going to say, a Eurozone actually without any growth engines at all. In the last 15 years, there's at least been Germany. That is on its knees economically. To have any of the other major economic areas not participating in the growth picture is pretty bleak, isn't it?
Simon, well said. As always, it's good to see you. Simon French there, Panmure Gordon, out of London this morning. Let's take two different perspectives on this. A market perspective, from a super tactical perspective. Just look at how the market stopped responding to bad news in Europe. Euro's stronger, French spreads are tighter. I'd put that to one side. And then I'd say, OK, well, let's take a more strategic view of Europe right now. No growth engines. France is ungovernable, which means it's unreformable, which I think means ultimately it has to get worse before things start to get better.
At this point, though, has that been baked in? And that's sort of putting together the market view versus the political backdrop. And then is there also a good degree of hope baked in that some of the crisis level of government dysfunction at the two biggest economies of the region will force some change? And at what point does that get checked? I mean, seriously, at a certain point, you start hearing about the lack of austerity in Germany. Well, let's see that.
Do you want a must-watch interview?
Please.
Just hearing from the team that the joint architect of this government's demise, Marine Le Pen, of the National Rally, has just sat down for an interview with Francine Lacqua. That interview has just wrapped up. So we'll bring you some headlines and some highlights in the next couple of hours. Stay tuned. From New York, this is Bloomberg. 4-day winning streak on the S&P for those counting, 56 all-time highs on the year so far, and still some time to go before we close out 2024. Equity futures down by 0.05%. On the Nasdaq, we're down by about a tenth. On the Russell, the small cap softer by a similar amount. In the bond market, the front end of the curve yesterday, yields were a little bit lower, putting some weight on the ISM services read coming in at a 3-month low. I'm not sure how much weight you should put that on that, Bramo, because overall, if we look at the so-called totality of the economic data, things still look okay.
They look okay. They haven't looked incredibly inflationary, and maybe that's where people are getting confidence that the Fed can still lower rates. Yesterday, it was just a small grind lower on the 2-year yield, but it's important to note that 2-year yields are now at a 1-month low as people believe that the Federal Reserve is interested in getting rates lower, even though the economic data is fine. It just isn't robust. They want to adjust, and that seems to be the message from all the Fed speakers.
We'll get more data a little bit later, 8:30 Eastern time for jobless claims. Then tomorrow, of course, 24 hours later, the big one, it's payrolls Friday. Let's turn to this one. Bitcoin. What a move we've seen. Up by close to 5% intraday. A clean break of 100K. Chairman Powell calling it what we all know it to be, digital gold, just yesterday.
And this essentially has been the moonshot bet post-election. It's up 50% since Donald Trump was elected president. We see this sort of euphoria collecting around Paul Atkins as the latest, heading the SEC or nominated to do so. A real question here about whether this opens the door to institutions to really go wholesale into digital gold at a time where gold itself is becoming a real diversifier for people worried about the ballast of bonds.
Mohamed Al-Arian this morning on Twitter talking about this, and he says one of the big changes taking place in the U.S. post-election is the emergence of a new counter-elite that is much more comfortable with innovations and disruptions, is pro-liberalization, deregulation, and generally less risk-averse. And we look at some of the economic names around President-elect Donald Trump, his SEC pick, what he's done in terms of communicating and going out an olive branch to the crypto community. That is, in essence, what is taking place right now.
Crypto absolutely unleashed over the last month. Bitcoin up by close to 5%. Under surveillance this morning, the New York Police Department saying an investigation into the fatal shooting of United Health Group executive Brian Thompson in Manhattan yesterday is ongoing. Authorities calling it a brazen targeted attack. The alleged shooter remains at large.
So, very scary what happened in New York City yesterday, this shooter at large. What struck me, Jonathan, I know we spoke about this earlier, is when you watch the video, this CEO is walking into the investor conference day alone. And the authorities are saying it's a targeted attack. And his wife, speaking to NBC News after, said there were some death threats and targets. And then Bloomberg has looked at some other big companies, Meta, Google, how much money they spend on security. And this individual did not have private security, even though authorities are saying this was a targeted attack.
So hundreds of security officials, corporate executive security officials, got together on a conference call yesterday. And I was reading about it, trying to figure out, OK, what do we need to do? I wish I could have been a fly on the wall in that conversation, because you can imagine this is the clarion call across Wall Street, across corporate America. Get your security in order.
It's an absolute tragic loss of life, and there's going to be a massive rethink on that front, that's for sure. Any details we get this morning, of course, we'll be sure to share them with you. Let's turn to the latest out of Europe. French President Emmanuel Macron searching for a new prime minister after lawmakers passed a no-confidence motion against his government. As we mentioned a little bit earlier, look out for this later. Bloomberg's Francine Lacroix sitting down with French national leader Marine Le Pen. We'll bring you that interview at 8:45 Eastern time. That is the leader of the National Rally Party in France.
And the person who really has been calling for the no confidence vote, and a real question here about whether she could actually even run again based on certain legal cases against her. But the bigger question is, how long will this take before it gets resolved? It took a long time for Emmanuel Macron to even get Michel Barnier in the door. So who is he going to have as the person? The method, the Barnier method didn't work. So what comes in next?
And someone who can pass this budget in this deeply divided parliament. But the reason why the market is taking all of this in kind is because they're going to pass a fiscal continuation law. Basically, we're going to be able to pay our bills. So the optics feel worse than fiscally what is going on under the surface. But Lisa, you made a great point earlier to Simon French. In the short, medium term, longer term, this can get very messy.
This is already messy. Now, I know the markets stopped paying attention to it, and there might be some signal in that. We can talk about markets and what it all means, that maybe the greatest scope is in Europe for upside surprises. We can do all of that. At the moment, France is ungovernable. And if you can't govern France, you can't reform. And if you can't reform, things are going to get worse before they get better. And as we know in Europe, they need to get a whole lot worse before you start finding solutions. And to be honest with you, looking at France right now, they're not there yet. It's not bad enough for them to do the right thing. And that, for me, is what is potentially quite scary.
And to build on that, the consequences of that really comes to businesses and executives trying to plan ahead for some sort of continuation of ongoing policy. If you take a look at surveys in the U.S. after the election, the fact that there was a result, that there was more of a focus on deregulation, confidence among business executives shot higher. At what point does the decline in business confidence in a place like France start to weigh that much more on the economy, just simply because how do you invest when you don't even know who you're going to be governed by?
I was there in May. It was full of happy talk. All the business leaders came in to meet with President Emmanuel Macron. Everyone was happy. France was the new UK. It was the epicenter of Europe. It's where the banks wanted to be. Happy talk, happy talk, happy talk. Here we are a few months later. No government, Macron under pressure, wants to stay in power, doesn't want to step down and resign early, doesn't want to call an election. What are you going to do in between? The answer to that is absolutely nothing. And if you're going to have them doing absolutely nothing at a time when the trajectory for Germany isn't clear either, they're going up against some serious changes. Look at what's happening in the United States of America. We've had a red wave, and yes, the margins are small, but ultimately they have a majority where they need one. You could see some big changes. We've heard from Scott Bessent, the incoming Treasury Secretary, is talking about a global realignment. Do you think Europe right now is in a position to manage a global realignment when the core of Europe, France and Germany, is absolutely directionless? What we heard from Pamela Gordon, Simon French just moments ago, what are the powers of growth for the European economy right now? Where do they come from? The ECB, Isabel Schnabel, someone who I have a great amount of respect for on the executive board, basically turned around recently and said, if we cut interest rates now for something that is a structural problem, it could be a waste of ammunition for when we actually need it. What does that tell you about what the ECB thinks is behind the downturn in economic growth?
Yeah, and how much are they expecting that to only escalate? Of course, some people were suggesting that maybe she was trying to bolster the euro just a little bit ahead of what promises to be a really punishing time. But you're right. How much of that is really priced in?
This makes the job for the Federal Reserve sound easy. Fed Chair Jay Powell downplaying the prospects of tension with the incoming Trump administration, expressing confidence that he can work with Treasury nominee Scott Bessent, saying he's confident that he'll have the same kind of relationship with Bessent as he's had with other Treasury secretaries.
He basically said it's going to be business as usual. And he also said something about President-elect Trump, which is basically like, do you remember when Trump used to tweet at Powell what he wanted the Federal Reserve to do? As yesterday, Powell said, the president said the same things to me privately as he said publicly. So we should take President Trump at his word when he talks about Jay Powell, what he plans to do with the Fed. And so far, what we've heard from President-elect Trump is that he is going to keep Powell in the job. And Powell's saying that it's going to be business as usual in terms of how I deal with institutions.
Let's keep it on the administration. Let's stick with politics. President-elect Donald Trump rounding out his economic team, naming former Congressman Billy Long to lead the IRS, former Georgia Senator Kelly Loeffler for Small Business Administrator, and former SEC Commissioner Paul Atkins for the role of Chairman of the Commission. Joining us now is Tobin Marcus of Wolfe Research. Tobin, welcome to the programme. A lot of focus on the Atkins appointment. A lot of focus because Bitcoin is rallying so hard. When we hear things like they are a crypto advocate, they are pro-crypto, Tobin, in practice, what does that actually mean for policy?
Well, the big complaint about the SEC from a digital asset perspective over the course of the past few years was the so-called regulation by enforcement approach that Gensler took. I think that's frankly more of an issue for a lot of these sort of smaller and newer entrant digital assets in terms of like not being able to get the clarity from the SEC that they wanted, either by trying to go through formal channels or through sort of seeking forgiveness, not permission. From a Bitcoin perspective, I mean, obviously, it's been able to thrive despite Gensler's approach to the SEC and has continued to rip higher. So, I think that's obviously a kind of an animal spirit story.
So what kind of U-turns can we see at the SEC under Atkins that were put in place by Gensler?
I think Atkins is going to be broadly deregulatory across pretty much every axis. I mean, he's talked about rolling back formal rules. He's also been critical of penalties imposed by the SEC in the past. So I think even where there are enforcement actions, he's going to be tending to take a more lenient approach with an eye towards not kind of reducing competition, not imposing costs that ultimately flow through to shareholders. A lot of the formal rules that Gensler put forward that have faced the most criticism are already in litigation. In terms of climate disclosures, for example, there's already litigation against the market structure rules that they put out earlier this fall. So I don't know how much of it is going to be a story of formally rolling back rules as opposed to just sending a very clear message that we're not going to try and regulate through enforcement. You don't need to sort of worry about what we're going to do quite as much.
We also know who's going to be filling in now, taking the job of Jonathan Cantor over at the DOJ when it comes to antitrust, and that's Gail Slater. What can we glean into what she has said in the past about big tech companies, into maybe how Trump 2.0 might potentially be a continuation of what the Biden administration was already doing?
Yeah, that was a very interesting pick. I think a little bit more populist at the margin than we expected heading into the election, where we did think we were going to get a fairly traditional pro-business Republican approach at DOJ and FTC from a competition policy perspective. I think the clearest signal about what she stands for is what Trump said about her announcement and what we can glean from her working for Vance, both of which are really focused on big tech in terms of what's in the crosshairs. I don't see as much risk in sectors that are not kind of explicitly targeted, as we saw under Khan and Cantor in the Biden administration. But her personal trajectory, I mean, she spent 10 years as a staff attorney at the FTC. She's done some work for the tech industry. So, looking at her resume, you wouldn't necessarily think that she's going to be pitchfork wielding. But I do think the expectation based on what Trump and Vance are saying is that we'll see some populism in that approach.
So far, Tobin, populism aside, a lot of businesses are looking at the agenda and saying this gives us a lot more confidence going forward in our business models. There were a couple of surveys done by different places, one of them showing that now 2/3 of business executives surveyed are optimistic about the path ahead versus 26% of respondents in August. Do you think that that is justified simply because of the deregulation? And do you think that was sort of, a commentary on the regulatory regime before?
Yeah, it's fairly typical to see very dramatic reversals in business sentiment on transitions. Generally Republican leadership tends to be better welcomed, especially, some of those surveys like NFIB have a very, very strong partisan valence to them. So, I think that's not terribly surprising. I think the sentiment swings tend to be bigger than the activity swings in terms of what people are doing versus what they're saying. But, I think in both cases, we're seeing stronger animal spirits. But, our expectation heading into the Trump administration, or heading into the possibility of a Trump win, was always that the good news would be kind of front-loaded on some of those priorities like deregulation that were very clear. And then the more potentially adverse news is backloaded in terms of what happens with tariffs, what happens with some of these offsets for a fiscal package next year, where we're going to need to wait to see where these risks land.
Backloaded at the same time that people are talking about how this is really going to be first-order priority for President-elect Trump when he takes office to put tariffs on. And I wonder how much you expect that to really impact sentiment. We've been talking to a number of people about how much investors are really aware of that, the idea of tariffs coming in and not just being a negotiating tool. What's your take on that? How much are the people you speak to taking it truly seriously?
So I certainly don't think tariffs are priced in from a market perspective. I think that's the clearest thing. Even people who are taking it seriously, I think it's very challenging to figure out, what are some of these single name trades, given how much discretion the president has in implementing tariffs and how much uncertainty there is about exactly what his agenda looks like. So, there's a lot of sort of interest in it. We're having tons of conversations with institutional investors about what that might look like. But ultimately, there is a lot of uncertainty, and I think people are going to need to see it to fully believe it.
Hey, Tobin, good to hear from you. Tobin Marcus there of Wolf Research on the outlook for policy under the incoming president. Keep going back to the same thing. Sequencing. Based on what we're hearing, it's tariffs first and taxes later. There might be a problem for people who are optimistic about the policy mix into next year.
And who think that all the positive news is front-loaded and that back-loaded is going to be some of these other proposals like tariffs that are going to be first-order priorities, unless you consider what we're experiencing right now, the front-loading of a policy shift before he even takes office.
Sometimes I'm confused why people think tariffs are going to be back of mind and second in nature when Donald Trump is already talking about them. He's going on Truth Social and he's actually now inviting negotiations because you have Canada's Justin Trudeau flying to Mar-a-Lago. You have the Mexican president getting on the phone with him. Tariffs are already happening, so they are going to be first in the sequence.
If things can change, but right now, based on what we're seeing, what we're hearing, what they're doing, they're top of mind. Equity futures right now on the S&P, totally unchanged, very near all-time highs. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President-elect Donald Trump is set for his first network interview since winning a second term. NBC announced Kristen Welker will interview Trump on Friday, with the full video and transcript to be released on Meet the Press this Sunday. According to NBC, Welker's exclusive interview with Trump in September of 2023 was his only network sit-down interview during the 2024 campaign. The yen strengthening this morning after one of the Bank of Japan's most dovish board members said that he's not ruling out a hike later this month. Board member Toyoaki Nakamura told media that he is not against rate hikes. He also told local business leaders that it's important to make decisions based on data. The BOJ's next meeting comes December 19th. OPEC Plus is set to hold a virtual meeting today to further discuss delays to its plans to boost oil production. The group has already deferred supply increases twice, with faltering demand in China and high supplies from the Americas. Some OPEC Plus members, including Russia, have criticized the group's long-term strategy, saying it has boosted rival supply and reduced their share of the global market. And that's your brief, John.
Danny, thank you. Crude oil a little bit lower this morning. We're down on Brent crude by 0.1%. Similar move on WTI. WTI crude 68.43. Up next on the program, Chair Powell taking a cautious approach.
The labor market is better and the downside risks appear to be less. We can afford to be a little more cautious as we try to find neutral.
That conversation up next. You're watching Bloomberg TV. So here is the constructive view. It comes from Jim Caron of Morgan Stanley this morning. He writes in, he's been following the program. Jim, thanks as always. The market's not missing anything. Everyone knows the tariffs are coming, but the markets do not think it will be as bad as some people fear. In fact, the market may see positives to it as well. If tariffs are targeted, it could help with manufacturing and capex as the US onshores. That's a more constructive view on things into next year.
When it comes to Mexico and Canada, the consensus right now is that those truly are negotiating tools. When it comes to China, there will be blanket tariffs, but it could be to force production home. That is basically what's baked into markets. And frankly, even policy advisors talking that maybe that's what's going on.
Keep the views coming in. We'll keep sharing them. Equity futures right now on the S&P, negative by just 0.05%. Yields are higher by a single basis point. The 10-year pushing 420 again at 419.54. Under surveillance this morning, Chair Powell taking a cautious approach.
The economy is strong, and it's stronger than we thought it was going to be in September. So the labor market is better, and the downside risks appear to be less in the labor market. Growth is definitely stronger than we thought, and inflation is coming a little higher. So the good news is that we can afford to be a little more cautious as we try to find neutral.
So here's the latest this morning. Fed Chair Jay Powell acknowledging the strength of the U.S. economy ahead of Friday's payrolls report. Sonia Meskin of UBS writing, we project non-farm payroll employment expanded 250K in November and upward revisions to prior months. Our estimate includes a rebound of over 40K due to returning strikers and nearly 60K due to rebounds from storm-affected regions of the country. Sonia joins us now for more. Sonia, good to see you. Good morning.
Great to see you.
How strong is strong tomorrow morning? Is 250 even strong based on what you just said?
Well, that's exactly right, because the real question is, what is the underlying trend? And a lot of what we're projecting is really the rebound from the prior months, right? So if we see roughly the average of 150K gains in employment over the last 2 to 4 months, is that strong? Is that weak? Is that just about right? We'd argue it's just about right.
Here's one man's opinion, Chairman Powell. He says things are strong. And because things are strong, we can afford to be a little bit more cautious as we try to find neutral. Translate that into a decision for 2 weeks' time. What does that mean?
For 2 weeks' time, we think they're still going to lower the rate by another 25 basis points. But broadly speaking, if you take the aggregate of what they've all said this week, we think they're setting out for a pause.
Is that basically the takeaway? Is that essentially they're going to cut like 3 times next year? They're setting up the telegraphing of that pause come December. And basically, they do want to bring rates down, but they're just going to move more slowly. Is the news over? Is that basically what they're telling us?
Right. So we're expecting them to actually not cut in January, to continue to cut broadly. The trajectory is down for rates, at least for the policy rate next year. But again, Is the Fed really the main game in town at this point in time? Because we have the term premium up by 50 basis points since they did a jumbo cut in September. We also have credit spreads that are narrower. We have equities that are higher. So is this really for the markets about the Fed's largesse at this point, or is it about other things?
You know, it struck me, and not to get all existential, but it is Thursday, and people are wondering about neutral rates, so I think that we can do this. Do we understand inflation? Do we understand what causes it? Do we understand whether tariffs are going to be inflationary or disinflationary or deflationary at a time where that's really going to be one of the driving market forces potentially next year?
Potentially, that's right. And there's been a lot of discussion of inflation surprising on the upside a bit or being potentially sticky. We think, for example, there are going to be obviously inflation numbers too before the meeting. We think that there is going to be a bit of upside surprise in these numbers, primarily from used vehicles and insurance and apparel prices. But these are all volatile as well. And broadly speaking, if the labor market is roughly in balance, no longer a source of inflationary pressures, as the Fed has pretty much said, and we don't get more supply-side shocks, the inflation should continue to roughly, on the trajectory to 2%. That said, of course, we've got the threat of tariffs coming up, so that could change things.
So Lisa's going to be existential. I'm going to be cynical. The Fed cuts before the election, then they cut the week of the election, and you say they're going to go on pause after the election. How political actually does that look if they decide not to cut in December?
Pure speculation here. Our guess is that they really want to be as far from political as possible. And notice how little they want to discuss potential fiscal changes down the pike. Not just the tariffs, but also the deregulation, which arguably is what's influencing expectations and financial conditions in the markets.
But if they come out with a pause and then Chair Powell goes into the press conference, he's going to be asked about why are you saying you're not in a hurry and why are you cautious? And it all goes back to the change of guard and change of policies in Washington.
Potentially, but also look at what he's already set up for it. We would argue yesterday when he talked about how much stronger the employment has been than they feared in September.
I'm going to do what Mike McKee would do. Defend the Federal Reserve. I don't usually do that. It's an original moment for Bloomberg Surveillance. I think the data gives them cover. And if they got anything wrong, it was the unemployment rates shooting higher, the nervousness around that, trying to get out in front of that. I think you can give them the benefit of doubt. They got it wrong on the labour market. Things have turned out to be OK, and I think the data gives them the cover to pause if they want to. And they can say it was that, and it wasn't that. It's not about the politics.
Which is the reason why they're telegraphing it now. And that's the reason why so many people believe, and it's baked into markets, they are going to cut rates and then say we're going to be on hold and we're going to be more cautious and we're doing it for obvious economic reasons. The Beige Book gave them cover too. I really enjoyed the Beige Book.
Yeah, it came in strong. I saw the same thing.
It did come in strong with people increasing their optimism, but confidence picking up post-election, but you didn't see that inflationary picture. You didn't see people really accepting higher prices, and that's also going to give them cover. Not to say transitory, that will never have happen again, but just to sort of talk about that disinflation.
The data's more than convenient. It's perfect for them. It just gives them a reason to slow down at a time that they might need to. They don't really know how close they are to neutral. Nobody does. Everybody's guessing. Just by definition, it's a big guess. Looking out into next year, it completely depends on how the tariffs are calibrated, how targeted they are. As Jim Carroll of Morgan Stanley suggested just moments ago, it could be a positive for the US economy. Could be a hit to growth, might be a boost to inflation. No one really knows that either. You take your time. To use that analogy he loves to use, you're in a dark room. The room just got darker. Go a little bit more slowly.
Yeah, and Dennis Lockhart said right now, yesterday, in a conversation on a Bloomberg event, don't screw it up. That's basically the feeling right now on the Federal Reserve. You got something pretty good, don't screw it up. Next year, how do they even model that? What models do they follow?
I don't think you can.
With
great difficulty.
Right, so how do you give forward guidance? That dot plot. What do we do with that?
Kevin Walsh comes out and does it for you. That's what's going to happen in the middle of next year. Sonia, It's good to see you. I'll save you on that conversation. Sonia Meskin there of UBS. Up next on the programme, Nouriel Roubini of Roubini Macro Associates, Jack Fitzpatrick of Bloomberg Government, Eric Resnick of KSL Capital Partners, and Kathy Jones of Charles Schwab. The second hour of Bloomberg Surveillance. Up next.
The U.S. economy still has significant advantages versus the rest of the world.
The Fed is correct in continuing to normalize rates.
You probably do want less bonds in your portfolio because, higher rates is not good for bond prices.
I don't think the Fed is in a position to cut as much as the market is priced for.
We do think that the Fed is going to cut here in December, but we think that next year's cuts are a bit in jeopardy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
We're still counting. 56 all-time highs so far in 2024 on the S&P 500. Equity futures this morning just slightly softer. We're down not even 0.1% on the S&P. On the Nasdaq 100, just a little bit softer. Likewise on the Russell, we're down a little more than 0.1%. Looking ahead to the day ahead, a little bit later this morning, 90 minutes time, jobless claims in America. We'll get the trade balance. You'll get some more Fed speak. The big one is tomorrow morning. At 8:30 Eastern Time tomorrow, when the payrolls report drops, how much of a snapback will we get in November from October?
And is good news good news? You just mentioned the 56th record high that we had yesterday, and I just want to put this into perspective. The gain so far, almost 28%. The highest gain for a full year in the 21st century was in 2013 at close to 30%. We are really close to that. So each of these incremental highs comes on the heels, yes, of better than expected economic data, but it speaks to a blockbuster year that has happened sequentially day after day.
I'd add to it just how unexpected that blockbuster year actually was. This time last year, the average outlook, 4,800 on the S&P 500. Try 6,000 at yesterday's close, north of 6K.
It reminds me of a time when people thought about a recession. Oh yeah, that was early this year. It heads into next year where everyone's expecting roses and gold, necklaces. And there's a real question here about whether they're overestimating some of the positive shock that could come at a time when everyone's got those beer goggle glasses. Remember Jeremy Stein from the Dallas Fed in 2013?
Richard Fisher,
whatever. Sorry.
I remember the speech.
Richard Fisher. Okay, I'm gonna.
I think it was him.
Now.
I think it was him.
Yeah, I think it was too.
Yeah, I mean, we can dig it out.
Okay,
we
let's
can do that.
I'll
Probably
do
should have
it right
done
now.
this in planning, but we don't plan. Okay, let's talk about policy. Just get away from that just for a moment. You're going to dig out that speech now.
I am.
I know you will. I'm pretty sure it was Mr. Fisher. Anyway,
Jeremy Stein.
Let's get to this. Tariffs, are they a good or a bad thing? Big debate already this morning. Jim Carroll, Morgan Stanley, wrote in a little bit earlier. He said everyone knows that tariffs are coming, but the markets don't think it will be as bad as some may fear. In fact, the market may see positives to it as well if the tariffs are targeted. It could help manufacturing and capex. Kevin Gordon of Charles Schwab writes in immediately and said it's worth noting that ISM manufacturing plunged after the tariffs were implemented in 2018 and industrial production slowed after that. There was not a manufacturing boost. That debate is ongoing into 2025.
Because there's a lot of questions about the inputs to the U.S. manufacturing that come from overseas and if any of this will drive up those costs. Also, you have to think about Trump 1.0. The retaliatory measures that China used, which was to go buy soybeans in Brazil instead of from the United States, and then the billions of dollars of the farmers' bailout that came from the federal government. And then my third point would be personnel's policy. A name we got yesterday that no one's really talking about is a name we know, Peter Navarro. He likes to be the last one in the room. So if Treasury Secretary Scott Bessent, once he's confirmed, goes and talks to the president, says you should really use this as a negotiating tactic, who's going to run in after him? Someone named Peter Navarro, who really wants to put the walls up.
We got derailed, so we should probably go back to it and get derailed again. Have we got confirmation?
Okay, really? I'm gonna resign now.
I think it's just sadder that I remember a speech from a decade ago.
Yeah, except that I got the date wrong and I got the person. It was Richard Fisher and it was 2014.
Okay.
But this was the quote.
The sentiment remains the same.
But the sentiment is actually fantastic and it's a great parallel. He talked about quantitative easing and the incredibly low rates of 2013, putting, quote, beer goggles on investors by creating a line of sight where everything looks good. What are the beer goggles right now? Is it simply that things really are that good?
It's a fantastic save and it's a fantastic speech.
Thank you.
And a brilliant quote, perfect for the moment we're in. Coming up this hour is the lineup for you. It looks like this. Nouriel Roubini of Roubini Macro Associates as a risk-on mood sends stocks higher. Eric Resnick of KSL Capital on job strength in the hospitality sector. And Kathy Jones of Charles Schwab making a case for bonds in 2025. We begin this hour with stocks mostly fat following the S&P 500's 56th record of the year so far. Nouriel Roubini of Roubini Macro Associates looking ahead to the new year and writing this. Some of Trump's policies will increase growth and reduce inflation, while others could be stagflationary. So the impact on growth, inflation and on markets depends on how much of the former versus the latter. Nouriel joins us now for more. Nouriel, wonderful to see you, sir.
Great seeing you.
How difficult does it make it to look ahead to next year with any real clarity, to come up with some kind of outlook when things are so difficult?
There's a lot of policy uncertainty. As I pointed out, some of the economic policies of Trump may increase over time growth, reduce inflation, being overall pro-business, keeping tax rates on capital and labor low, deregulating the economy, and things like increasing the production of fossil fuels and pushing down the prices of energy. Probably also this Dodge initiative over time may increase economic efficiency and so on. So those are the positives. And over time, they could increase growth, they could reduce inflation. But we know there are some sets of other policy. We don't know how much they're going to be implemented. They will increase inflation and potentially be stagflationary. In my view, tariffs are inflationary. Protection is the risk of an economic war with China. First, draconian restriction to migration, if not a mass deportation. If we have unfunded fiscal deficits and the promises imply $8 trillion of deficits additional over the next 10 years, that's going to crowd out growth by increasing interest rates, nominal and real, and the bond market vigilantes are going to wake up. If you try to disorderly weaken the dollar, that could be inflationary, and if you interfere with the independence of the Fed. Now, I think on the positive side, I think there are a number of factors that are going to constrain the bad policies. One is market discipline. If you follow policy inflationary, then bond market vigilantes are going to wake up, bond yields are going to go higher, the stock market is going to correct, and he cares about the bond market, he cares about the stock market. Secondly, Fed independence. If he follows policies that lead to inflation, the Fed may not continue to cut rates next year, may even raise rates if inflation were to be going higher. And also policy choices. As you pointed out, on one side you have people like Scott Bessent who want to escalate, de-escalate on tariffs, and others who are total trade hawks on trade and on China, like Peter Navarro. So it depends on the balance between who's going to be in power.
Let's unpack some of that and pick out tariffs. Big debate already so far this morning. You've heard some of it. Please weigh in. If it's targeted, could it be a good thing for the American economy?
Well, if it's targeted, I would say that the impacts on inflation are going to be modest, and maybe some of the reshoring that already is occurring is going to continue. And there'll be actually pressure on our trade partners to say, if you don't want tariffs, you have to bring more investment, semiconductors, autos, EVs, you name it, to the United States. So that's the escalate in order to de-escalate. But I would say the higher those tariffs become, the more there's an impact on import prices, the more there's an impact on inflation, and the more there is global fragmentation. There's also the risk, of course, of trade wars, of our trade partner retaliating against the United States. If that occurs, the impact on growth is going to be more negative, the impact on inflation is going to be higher. Depends on the size of these tariffs. If it's Navarro types of policies on trade, it's stagflationary. If it's escalate, de-escalate, maybe the impact on inflation is modest and the negative impact on growth is also modest.
So some people are arguing that we're in this wave of deglobalization that basically reverses some of the disinflationary forces of the 3 decades following really the mid-'80s. I'm wondering whether that's actually true, whether that's what we're seeing, because there still is quite a bit of trade. It's just going different routes. And frankly, you could see that overproduction from places like China are going to lower prices in certain places, even if they don't in the U.S. if their wall's up. In other words, are we overestimating the inflationary impact on a dramatic level of a lot of these tariffs?
Well, the impact of high tariffs on the United States would be inflationary. But if you think about the impact on growth and inflation in the rest of the world, will be disinflationary. Because if there is a shock to the demand for the exports of Europe, Asia, China, then there'll be excess supply. Growth is weakened in those parts of the world, and that leads to disinflation in the rest of the world. So the impact on the US of high tariff is inflationary. The impact on the rest of the world is disinflationary because of excess supply.
You used to be called Dr. Doom. Are you retiring that mantle?
I always said I'm not Dr. Doom, I'm Dr. Realist. There are plenty of upside in economic growth. And by the way, some of them I think are more secular. I think the impact of technological innovation implied that potential growth in the US by the end of the decade could be close to 3%. And the fact we already have seen for the last couple of years growth of 2.5 to 2.8% with inflation falling is a sign that maybe productivity growth is increasing and potential is increasing and we can grow faster with having lower inflation. So I'm not Dr. Doom.
Well, when it comes to tariffs, just to go back to this idea of the personnel, we know what Jameson Greer as well thinks about China. In a hearing to Congress, he had talked about strategic decoupling. Do you expect that over the next 4 years between Beijing and Washington?
Yes, I do. I think that one of the biggest risks is not just tariff in general, but a broader economic war against China. If listen to the long list of complaints of the Trump administration, they say China has been free riding on international trading system, tariff, non-tarifary barriers, government procurement policies, FDI policies, intellectual property rights, and of course fentanyl and lots of other things. And also geopolitically, there may be an attempt to try to contain the rise of China. So the biggest risk is not just tariff on China, but how much the overall policy toward China is going to be confrontational. And if they feel that we're trying to contain the rise, they could become quite aggressive themselves.
Well, front page of the FT today is talking about these 4 government-backed authorities that are telling local chip companies that you can no longer buy silicone from the United States. They're no longer safe or reliable. Are we already in this moment you're describing?
Well, certainly in anything to do with high tech, we've started already in the Biden administration to be in a process of decoupling, restriction to exports both of semiconductor and semiconductor equipment, restriction to anything that's related with AI and high technology. Under Biden was a narrow yard and high fences and stuff that was supposed to be critical. So de-risking, I think that in the case of Trump administration, we may move from de-risking with China to decoupling with China. There's something much more, severe.
Does Europe need to pick a side?
They'll be in a very, very tough position because geopolitically, Europeans are close to the United States, NATO, and so on, but they do a lot of trade and investment with China. Under the Biden administration, it was easier because there was a compromise within the G7 about de-risking as opposed to decoupling. If the US goes towards decoupling and says Europeans have to follow us, otherwise there are consequences, not just on trade, but also on NATO, security, and you name it, then I think Europe is already weak, will be in a tougher spot.
How much worse could things get for the Europeans? We've been saying through this morning that France is ungovernable at the moment, which means it can't deliver reforms. And in Europe, things have to get worse before ultimately they find solutions. How much worse does it need to get?
Well, things are really pretty bad already in Europe. I think that potential growth is below 1%. In Europe, Europe is going to be in the Eurozone less than 1% next year. So, and structural reform are not going to occur anytime soon. There's a fragmentation between these 27 countries. Some of them want more integration, some of them want less. At the core of Europe, Germany and France are going to be politically unstable. So I don't see either the Letta report or the Draghi report for more integration, for a common market, for more productivity and competitiveness being implemented. So it looks pretty dark for Europe right now.
Which is the reason why I'm surprised that so many people come in and they say it's priced in. We don't really see a path out of here. We don't necessarily see an economic engine or the political will or capability to really counter it. At what point are we facing off with a potential dollar shock? And I ask this because, yes, the euro is likely to stay around here or weaken further, but what if it actually weakens dramatically as the ECB is forced to cut rates and that divergence widens?
Well, there are many good reasons why the dollar may continue to strengthen. One is, of course, tariff. If they reduce the trade deficit, it's going to strengthen. 2, Trump had said, I want to have actually the dollar at the center of the global reserve system, and therefore that implies you want strong dollar than a weaker dollar. Relative growth differential, relative monetary policies, the fact that the U.S. is innovating and capital is flowing into the U.S. capital markets and the stock market all imply that the dollar over time should become stronger, the euro and other currencies should become weaker. The problem, however, is that Trump says a strong dollar has led to deindustrialization, to American carnage, people free riding on us, to having large trade deficit, and we want at some point a weaker dollar. The fundamentals imply a stronger dollar, but policy there may be an attempt eventually, maybe in the second half of the administration, to find an agreement on currency, maybe to say either you accept 10% tariffs or you accept a 10% depreciation of the dollar. I would not rule out there'll be some big Mar-a-Lago agreement. These FX agreements are always in a resort. Bretton Woods, Camp
Mar-a-Lago
David,
Accord,
Plaza, Louvre, and so on. So a Mar-a-Lago Accord is something that they're going to think about. Not in the first 2 years, but down the line, they're going to say to the trading partners, you don't want tariffs, you have to do other things for us.
We'll pick up on that story
might be currency.
in just a moment. We'll talk about the currency market and we'll talk about Bitcoin. Bitcoin through 100K. Nouriel Roubini on Bitcoin. in a few moments' time. Noria Roubini Macro Associates, will be sticking with us. Let's take the opportunity to get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. The search continues for the man who allegedly shot and killed United Healthcare CEO Brian Thompson. Police say Thompson was specifically targeted in the attack, but they do not yet have a motive. Thompson's wife said that he had received threats before he was killed. Police are offering $10,000 for information on the case. Shares of Dollar General rebounding to 2.25% after selling off earlier when the company reported third quarter earnings that fell short of estimates. The discount retailer also cut its full year guidance. The results do highlight ongoing difficulties at Dollar General, which had brought back its CEO last year to focus on simplifying operations, but those shares are down 40% already this year. The makers of cognac and champagne are ramping up efforts to ship their products to the U.S. ahead of President-elect Donald Trump's potential tariffs. LVMH has increased consignments to the U.S. for its Hennessy brands, with intentions to do the same for its champagne label Moet and Chandon. One source says that Hennessy had already increased its shipments by about 10% annually. And that's your brief, John.
Just a rush to secure DP. I get it. Dom Perignon, really quickly, get a case
DP.
Just before the tariffs come.
Really? DP.
2012.
Is that what
nice
you call
vintage.
it in your house?
No, I was nodding.
I know.
He knows.
John once served
He
this
knows.
vintage bottle.
It's true. Up next on the programme, talk about real things. Trump's team preparing to hit the ground running.
The big things that are going to move the markets next year are probably going to be immigration, tariffs, and fiscal. Fiscal is going to remain loose. Immigration numbers are going down. And on tariffs are going up. It's still possible and probably likely the magnitude of each of those things ends up being higher than anticipated.
That conversation up next with Bitcoin, a record highs through 100K. We're up by more than 5%. We'll get Nuriel's thoughts on that in just a moment. Equity futures right now just about unchanged on the S&P 500. Bond yields just a little bit higher, up 2 basis points. The 10-year pushing 420. Under surveillance this morning, Trump's team preparing to hit the ground running.
The big things that are going to move the markets next year are probably going to be immigration, tariffs, and fiscal. Fiscal is going to remain loose. Immigration numbers are going down. And on tariffs are going up. It's still possible and probably likely the magnitude of each of those things ends up being higher than anticipated. Tariffs are Trump's favorite tool, and directionally they're going up. That shock is probably the one that could be the largest next year that's not priced in right now.
So here's the latest this morning. President-elect Donald Trump adding to his economic team, picking former Commissioner Paul Atkins to lead the SEC, also naming Peter Navarro as his top trade advisor, with Michael Falkender to serve as Deputy Treasury Secretary. Bloomberg's Jack Fitzpatrick joins us now from Washington. Jack, welcome to the programme. Is there a common thread between these selections?
Yeah, I think there's two common threads. One is deregulation and a conservative outlook, and two, a history with Trump and loyalty to Trump. You look at Paul Atkins, obviously on crypto, generally on the SEC's portfolio. He has a much more of a focus on deregulation than Gary Gensler. That's a sharp turn away from the Biden administration's approach. Navarro, clearly a history with Trump, someone who declined to comply with a subpoena from the House January 6th committee and served 4 months in prison. Michael Falkender, also someone with a history with Trump, serving in the Treasury Department in the first term, had a significant hand in the PPP loans in the early stages of the pandemic. So a conservative outlook and a history with Trump and a loyalty to Trump, I think, are the main takeaways from the recent picks.
Jack Fitzpatrick down in Washington, D.C. Jack mentioned crypto. Let's talk about Bitcoin. Bitcoin pushing 103K, up on a session by more than 5%. Nouriel Roubini is back with us. Nouriel, you've had a big move in Bitcoin over the last month or so. Had a big move over the last several years. Have you rethought the way you think about what's happening here?
Not really. I mean, people talk about Bitcoin being a cryptocurrency like the other ones, but they're not really currencies. They're not a unit of account. They're not a scalable means of payment. They're not a stable store of value. They're not a single numeraire. Bitcoin in the past went to 17 down, then to 16. Now it's above 100. You could have another 50% correction. So it's a speculative asset like meme stocks, SPACs, and others, highly volatile. Many people are going to it, but take El Salvador. They force everybody to use Bitcoin as legal tender, and less than 1% of all transactions are occurring in Bitcoin. So I don't think it's going to ever become a currency, but it's going to be a speculative asset.
One thing the dollar is depreciated against is Bitcoin. And I think this is where I would see some separation between what's happening with meme coins and meme stocks and what is happening with Bitcoin. There seems to be a preference. There are market participants who believe that this is a place to be if you're worried about the depreciation of the US dollar and a fiscal trajectory of the United States of America. Do you see a case for it there?
Not really, because actually when the Fed was essentially rising rates and inflation was higher, Bitcoin was falling, like in 22, as there was the stock market correction, and now the stocks are going higher, and the Fed is easing, and inflation has fallen, Bitcoin is going higher again. So historically, it's not been a hedge against inflation. Actually, it looks like it's highly correlated positively with stocks, a beta relative to the equity market. So it's not a traditional hedge like gold that is in periods of time of inflation rising or debasement or worries about the dollarization. So it's something to me looks like speculative asset is highly correlated with equity. So it's not a hedge against inflation.
You say sort of parallel tracks to meme stocks and some of the other euphoria that we've seen. At the same time, there seems to be something more concrete behind this. You mentioned gold, and we are seeing that rally in gold in tandem because of what John is talking about, that store of value outside of the US dollar to protect against some sort of loss of fiscal dominance. Do you see, with a more institutionalized structure endorsed by a presidential administration, there being a case for at least a crypto-based store of value that could offset some of the risks of volatility in the dollar and the potential loss on the margins of fiscal dominance down the road?
I'm not sure, because if you're worried about inflation, the basement of fiat currency, or even the dollarization, there are plenty of other assets that provide a good hedge. Short-term treasuries, tapes, oil, ag commodities, gold, precious metals. So it's not as if there is not other alternatives. And as I pointed out, in the last few years, when inflation was higher, actually Bitcoin was falling. And when inflation has fallen, Bitcoin is going higher. So it doesn't look like it's been actually negatively correlated with inflation. So it is a speculative asset. For some people, it is a store of value. But if you want to hedge yourself against inflation, I think there's a spectrum of variety of other assets that are backed actually by real income or something, store of value, that are a better hedge against some of the risks that people worry about.
But given the change of tone in Washington, do you think there could be retail adoption at any point?
Yeah, and there's already been retail adoption, but my worry is actually that the regulation on crypto might become looser like they were before, and then you have another speculative run, you have another sets of scams like FTX, SPF, and so on, and then you get another bust. So the risk is we're going to go towards very little regulation. We know there are lots of players in this space that are quite shady, and the lack of regulation actually leads to a bigger bubble and a bigger bust down the line.
Known you a long time. Just want to finish up with something positive. Looking out to 2025. Favourite region right now? Favourite economy? The place you're most optimistic about for next year? Which one?
It's a bit consensus, but I think the United States still is going to outperform, both in terms of economic growth and equity markets, yes.
It seems to be the one place to be. Hear it repeatedly, don't we? The United States, it keeps coming back to America.
It feels like TINA. This is the TINA trade. There is no alternative at a time where essentially growth is concentrated in the world's biggest economy. And maybe it's trickling out, maybe it's not. But nonetheless, you also have yield here.
Nouriel, it's good to see you, sir.
Great.
Thanks for catching up with us. Thank you. Nouriel Roubini there of Roubini Macro Associates. Bitcoin right now up by 5% and pushing 103K. Up next on the programme, Eric Resnick of KSL Capital Partners on job strength in the hospitality sector. As we count you down to more jobs data, Jobless claims about 1 hour away, and then tomorrow it's the big one. It's Payrolls Friday. The estimate in our survey around 220 through the week so far. The estimate currently is about 215. From New York, this is Bloomberg. Equity futures right now 2 hours away from the opening bell. just about negative by not even 0.1% after closing at another record high in yesterday's session. On the Nasdaq 100, we're down by close to 0.1%. With 2 hours until the opening bell, with your morning movers, here's Manus Cranny. Good morning, Manus.
Jonathan, good morning. I see you couldn't shift Nouriel off the idea about the investability in crypto. Crypto is on fire. Bitcoin is lit up like an inferno, breaking through that 100,000 barrier. This is just a personification over at Coinbase. What will Paul Atkins do? Is he going to have the opportunity to reduce the enforcement actions? Will he really unleash new animal spirits that can drive even more money into the ETFs and onto the exchanges? $32 billion so far this year has gone into the ETF world. And crypto is up, well, I should say Bitcoin is up by $1.3 billion since the Trump election. Have a look at the software company Synopsys. I think this is interesting. Electronic design for automation software. Yes, they're talking about double-digit growth for next year, but the reason we're down by nearly 9%, the CEO says it is a tale of two markets. The AI build-out is like a rocket ship rolling away, but the reality in the rest of the semis world for them is just doing fine. And doing fine is just not good enough. So this is about a temperance on the guidance. Yes, they're going to make a balanced growth outlook, 11.5% to 12.5%. That's tailing off from a growth rate of around 15%. Five below, this is about a new CEO and an upward momentum in guidance. We're going to get Winnie Park, former Forever 21 CEO. KeyBank says merchandising, marketing skills, background, the perfect kind of fit. JP Morgan up the stock to $110 in target from 83. You got Guggenheim, Morgan Stanley. Guggenheim at 140, Morgan Stanley at 120. So it is about the holiday season being off to a good start as well. Five below. Jonathan, good morning.
Manus Cranny, good morning once again. Enjoyed that. Thank you. We'll catch up with Manus in about 60 minutes from now. Under surveillance this morning, President-elect Donald Trump announcing more key economic picks for his second term, including Paul Atkins for SEC chair and former Missouri Congressman Billy Long for IRS commissioner. Finance professor Michael Faulkender, who served during the first Trump administration, is his pick for Deputy Treasury Secretary under Scott Bessent.
So I think getting more of the names and personnel's policy, you can see playing out what Terry Haynes described as a cabinet of rivals. You're going to have the likes of Peter Navarro, Howard Lutnick, Jamieson Greer versus Kevin Hassett, Michael Faulkender, and Scott Bessent when it comes to this idea of tariffs. What I would say, though, amongst these new names in the economic space, they don't look like they're going to have the same kind of hurdles in Congress in terms of getting confirmed with some of his other picks. We're still waiting on what's going on with his defense pick, Pete Hegseth.
Which speaks to Scott Bessent, because the Treasury Secretary was meeting with the incoming Senate Republican leader, John Thune, just yesterday, both coming out of the closed-door discussion, emphasizing a willingness to work together. Bessent hasn't really raised any red flags whatsoever from GOP senators over the last few weeks.
No, Scott Bessent is going to really it's going to be very smooth, and he's going to glide through the Senate confirmation hearing. But he is being quiet. He's being quite direct to reporters, but not saying a ton, not giving a ton of details when he's coming out of these meetings, want to keep it behind closed doors. You know, people in the Trump camp call him that he has some sort of chilly charisma, and I think that's what he gave some of the journalists waiting outside John Thune's office yesterday.
What does that mean? Are they saying he's cold? I've met Scott Bessent a few times. There's nothing cold about him. He's quite a warm guy.
Chilly charisma?
Chilly charisma.
It's
Chilly
basically
charisma, yeah.
competent, but not necessarily caving to the requests.
So he's being cold with journalists.
Yeah, exactly.
Chilly charisma. He's charismatic, but he's not taking it over the line when maybe some others that have been named in Trump's cabinet have.
Got it. All right, I think I've got it anyway.
He's not Howard Lutnick.
He's not Howard Lutnick.
Yeah, so that's basically the
bingo.
If that's the bar for charisma,
exactly.
like, we're all miserable.
Oh, 100%.
Right?
Just chilly.
OK. Bitcoin, exuberant. Through 100K for the first time on the back of Trump's selection of Paul Atkins as SEC chair. The digital asset industry optimistic that Trump will pursue crypto-friendly policy and halt tough government scrutiny.
Basically, if you liked crypto yesterday, why not love it today? And it seems like this 50% rally that we've seen in Bitcoin just is a momentum trade that nobody wants to get in front of. I think Nouriel's point's really interesting. If you start to get less regulation, what is the risk of a potential further escalation, further euphoria, and then some kind of bust with potential malfeasance under the hood? I mean, are we going back to NFTs? I'll create one.
INET didn't like that period at all. I think this could be something else. potentially. Look, global markets are on fire this year, and Bitcoin's a big piece of that as well. I actually got a message as Nouriel was speaking saying, please point out to him that it's correlated the most to global liquidity. And that seems to be the story of the last year.
And you could make the argument that historical precedent doesn't necessarily tell the future story if you're talking about a regulatory regime change and if you're talking about a nascent asset. I mean, it's sort of this question of Amazon and how long did it take to become profitable before suddenly, really hammering that home and dominating an entire industry. So a lot of question marks here. I'm not one to throw cold shade on Bitcoin. In fact, maybe I need to buy a Bitcoin at $103,000.
I'm hearing the same arguments against it that I heard at 10, 15, 20, Correct. 25, and the whole way up over the last few years.
I'm humbled.
Markets very focused on one thing tomorrow morning, and that's the payrolls report, with the hospitality sector coming into focus. Bloomberg Economics writing the following: as this sector has been the biggest drag on headline payrolls in past Novembers, we think underperformance here will be a major factor in a disappointing headline print. A man who has to manage the hospitality sector is Eric Resnick, the CEO of KSL Capital Partners, which invests in travel and leisure. He joins us now for more. Eric, good morning. It's good to see you.
Good morning, John. Great to see you all today.
How are things going? You manage in a hospitality sector. What does the labour market look like at the moment?
Well, if you step back, we're the largest private investor in travel, solely focused on travel. We believe in the world. We have about 25 billion assets under management. 2/3 of that's in equity, 1/3 in credit, and we employ about 50,000 people. So when we look at that, I realized that in October there was comments on the softness in leisure hiring. We don't really see that. So it's there's been, I think, a resurgence of consumer confidence post-election when you alleviate the uncertainty around the presidential election. And so we're seeing bookings strong when we look into 2025. So I anticipate that whether the November jobs report is strong or not, I suspect that you'll see increased hiring as we look out over the next few months.
Before we continue, you mentioned the sort of uncertainty around the election and that affects travel. Can you explain why? Because none of us can figure that out. We've been trying to understand this, is that there's an election coming up, so I better just stay home.
I was hoping you could tell me. It's an odd thing, but we see it most. This is not specific to this election. Often in presidential elections, right, ad spending goes up, and generally consumers become a little less confident. I think it's just the basics of uncertainty is unnerving. Unnerving is less confidence. Less confidence, you don't spend as much, and travel's a place. In that circumstance, you tend to delay a little bit. So we saw a little bit of a softer third quarter and fourth quarter bookings going into the election. We've seen it rebound since. And when we look to 25, bookings are up. For us, advanced bookings are up about 15%. So we're very excited about that. But it is odd to me. I can't give you an answer. I wish I knew.
So when you talk about hiring, and I do want to stick on that because that's one of the key components of people's confidence and their ability to keep going and traveling. How much easier is it to hire people now? I remember a time post-pandemic where it was incredibly difficult and you couldn't find people. And in order to find somebody, you had to find someone who didn't work very hard and pay them $30 an hour after paying them $15 an hour. How different is it now?
It's very different. I would say, zooming back, what's $15 an hour, like you mentioned, is probably more like 20. In big cities, it's more. But if you look across the industry, I would say it's gone 15 to 20 over 4 or 5 years. So that's still meaningful wage inflation. That has helped. So right now, we are staffed well above levels that we're typically staffed at this time of year in terms of the pace of hiring for us going into the winter ski season. So we are basically 95% hired across Alterra Mountain Company and the Icon Pass, which is our ski pass that we created about 7 years ago.
He's catering to me. Go on.
Right, looking straight to you.
Yeah.
Over that time period, we've seen a dramatic ramp up in demand for skiing, and hiring this year has gone easier than it has probably any time since pre-pandemic.
Which raises this question about how sustainable this is going forward. And I don't want to get gloomy because this is all very positive and vacation plans are something that we all want to make. But I am curious about whether you're sort of getting to this place where what we hear from companies is that consumers are pushing back against price increases.
I think that's true.
They don't want to pay that much more. Hiring is pretty easy. People are plentiful in terms of availability, not demanding that much more. Does this speak to a moment that in the past, over your decades in this industry, have been tipping points where things start to not be quite as good?
I think that the rate of growth, which was robust coming out of COVID, has now stabilized to a more normal rate of growth. There's no doubt about that. I think we also see that the more luxury end of the market is growing faster than the lower end of the market. This past year, you've seen 3 or 4% RevPAR growth in the luxury end of the market. You've seen a couple percent RevPAR decline in the economy end of the market. I think that speaks of a bit of what you're going after. There is some pricing fatigue out there. I think the consumer's willing to pay at all ends of the market. They're willing to pay for service. You have to execute against that. If you don't execute against it, you're going to be a net loser in that industry in terms of market share. So for us, we try to be an employer of choice that helps us on gaining effectively market share of the labor market, and we try to be I'll try to also provide choice to the consumer, value to the consumer in terms of high-end service, so that they feel like while they're paying more for their vacation, they're getting more as a result. And so if we get that equation right, I don't think there's any inflection point that we're at now that's negative. I think we're in a 60-year cyclical trend of people spending more towards experiences over material goods.
When it comes to employment, though, how are you thinking about potential change of policies and the crackdown of illegal immigration by the incoming Trump administration and what that could mean for the supply right now in the market?
Look, it's a relevant issue. Again, for us in our industry, legal immigration policies are very important, and creating vertical pathways for often legal immigrants and people getting their first job and giving them an opportunity to grow their careers over time in the leisure and hospitality industry, we think is a wonderful opportunity that our industry provides. Now, we take very seriously making sure that our employees are legally here, and I don't think there's a broad issue in our industry in that regard, but certainly anything—
Not in the industry, but the knock-on effects.
There is a knock-on effect. We'll see what happens. There's talk and then there's action. Certainly, we can't predict exactly what's going to happen. If there were something that resulted in a meaningful pullback in that kind of entry-level labor market, that would certainly have a knock-on effect, as you mentioned, Anne-Marie, in our industry. But what we have shown, that could be inflationary. If there's less available labor, it could be inflationary on wages. If that's the case, we've shown in our industry that we're very resilient. Just looking back to COVID, we were able to manage through a period of rapid inflation and come through that actually healthier than we went into it.
Post-COVID tourism flows have shifted, though, and geopolitics has been an element in that. Russian tourism has disappeared in certain places. The Chinese tourist was very slow to come back into the United States of America as well. What are you noticing with regards to that? Where's the tourism coming from? Where's it going? Where do you want to be? Where do you want to have a property?
Well, I can't give you a specific answer on prospective investments, but what I would say is Indian tourism is way up. China is down. Middle Eastern tourism is up. Russia is down. American tourism to Europe is up. European tourism to the U.S. has come back actually quite robustly. Japanese tourism is down to the U.S. Chinese tourism, or actually all tourism to Japan, is up. Currency flows, macroeconomics all come into play there. We think of those as short-term trends, generally speaking. When you look over the long term, fundamentally, we think that global tourism, global travel flows, if you will, all generally are pointing up and to the right. But yes, everything you said is true. For us, we're looking for those unique destinations that have broad appeal. Ideally, a place that we can take a consumer, if they haven't appealed to the Indian tourist, how do we create more appeal so the Indian tourist that's growing will come to our new destination? Maybe that's in Italy, maybe that's in the U.S., maybe that's in our resorts in the Maldives, just as one example. But I wouldn't say that we're particularly concerned about that. We've never where the trends are weaker. We've never had a lot of Russian demand, for example, at our properties. But yes, you are right. When we look at markets like Courchevel in France, just as a consumer, the Russian travel to that market is down materially over the last several years.
So I know you can't talk about prospective deals, but you could talk about the type of deals that you are interested in. And you had been focused much more on debt. Now you're much more shifting your focus to equity investments. Why?
Well, I wouldn't say it's a shift. It's more, if you look back last year, a typical year, we deploy about $3 billion of capital, half in debt, half in equity. In the last year, debt was up 50% and equity was down 50%. And that was simply a symptom of a big bid-ask gap between buyers and sellers on equity, offset by a tremendous amount of refinancing demand, combined with bank pullback on the credit side. Looking forward, we still see those same trends in credit, but on the equity side, we see real reason for optimism. We see NDAs that we've signed increasing. We've seen initial conversations with banks and sellers increasing going into 25. Debt availability is there, so that helps finance acquisitions. Interest rates are down 75 basis points, hopefully more coming. So all of that bodes well for the equity market as we go into the first half of 25. It'll take a quarter or two to play out.
Just before you go, I am an amateur hotel and restaurant critic. Congratulations.
I'm aware, yes.
Il Sereno, Lake Como. Fantastic property.
It is a fantastic
Absolutely
property. I highly recommend it. The self-drive boats there are fantastic.
I did that. The mini Riva boats. It's a beautiful thing.
They are a wonderful
Amateur.
thing.
Amateur restaurant.
Thank you for being one of our past guests.
Anytime, sir. Anytime. Eric, thank you. It's good to see you.
Thank you. Great to see you all. Appreciate you having me on.
Eric Resnick there of KSL Capital Partners. For those of you wondering, I paid full price. Let's get you an update on stories elsewhere this morning.
We appreciate that.
With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. President Emmanuel Macron is searching for a new prime minister after no confidence vote against his government was passed, ousting Michel Barnier. Macron needs to find a prime minister who can pass a 2025 budget through a deeply divided parliament. Bloomberg's Francine Lacroix sat down with Marine Le Pen earlier this morning, and we will bring you that interview at 8:45 a.m. ET. U.S. business executives are more optimistic about the economy and their business after Donald Trump's presidential election victory. 2/3 of execs polled by the Association of International Certified Professional Accountants said that they are confident about the economic outlook for the year ahead. That's up from 26% from August and 43% from a year earlier. JetBlue is cutting more unprofitable routes, including flights from New York's JFK to Miami. It's also suspending services, some of them, to Europe. The airline says that it's refocusing on core markets, attempting to restore profits after a failed merger with Spirit and a block partnership with American Air. That's your brief, John.
Thank you. More from Danny in about 30 minutes' time. Up next on the programme, next year's comeback trade.
Into next year, we actually see disinflation. We see a bit weaker growth. It might be a year of a comeback trade in terms of bonds.
That conversation up next, live from New York. This is Bloomberg. Ten-year government bond yields picking up just a touch. We're up by, let's call it 4 basis points now on a 10-year through 420, 421.67. Going into jobless claims later on this morning. That number drops in about 40 minutes from now. The estimate in our survey, 215. The previous week, 213. Under surveillance this morning, next year's comeback trade.
Into next year, we actually see disinflation. We see a bit weaker growth. We see earnings growth that isn't going to hit the bar of 15% next year. We see elevated equities and elevated bond yields. So you put all that together, we're tilting a bit more conservative. It might be a year of a comeback trade in terms of bonds.
So here's the latest. Market volatility and policy uncertainty pushing some investors back towards fixed income. Kathy Jones of Charles Schwab warning of a bumpy ride in 2025, but writing the following. Despite our caution, we also recognize that volatility can translate into opportunities. Higher yields potentially can provide investors with more income and stronger returns in the long run. We expect to find areas in the fixed income markets that can deliver solid returns in 2025. Kathy joins us for more. Kathy, good morning.
Good morning.
It's all lining up to be pretty good. Softening growth, moderating inflation, lower interest rates. That screams buy bonds. Is there anything that could change on the policy side that might disrupt that?
There's several things. Obviously, tariffs, which have been discussed many times, at least a one-time price level increase on those goods that have tariffs attached to them. So that's one thing. And then if you get counter tariffs and retaliation, then we could get into a kind of ugly trade war, which wouldn't be good. Immigration policy, if we really reduce the size of the workforce substantially through deportations or just limiting immigration, then we're looking at probably higher salaries. And shortages in some industries could be particularly acute, like construction, where housing is already very expensive. And then, you look at tax policy. Now, that's probably a 2026 issue. But if we get, more tax cuts with the deficit rising, that puts more upward pressure on inflation if we're still running at a pretty healthy economy. So those policies are all up in the air. We don't know the dimensions of them, but they're all a possible risk.
I remember when we were heading into the election, there was a thought of a red sweep was going to be catastrophic for bond yields, and you're going to see bond yields sell off dramatically, 10-year yields spike higher. What we've seen since the election is the opposite, actually, is we've seen longer-term 10-year yields come in. Do you think that that's a head fake? Do you think that basically people were worried about the wrong thing?
Yeah, I mean, it's really hard to interpret, in a short time period what's driving it. We did get much stronger data as of September. Those revisions to the September data, we looked like we were going into a real slowdown with lower inflation. And then all of a sudden the revisions to the employment numbers and all the numbers came in strong. So that was part of what drove us going into the election. And then I think there were some concerns, and now there's kind of relief. Well, we don't really have any dimensions to worry about yet because we don't know what they are. But we're sitting at relatively elevated yields if you think that the Fed's going to cut rates some more, as they've indicated.
I wonder if one of the most consensus trades of this year is going to get upended next year. And I'd love your thoughts on this and the idea of a steepening yield curve. That's what everyone's been sort of piling into because the Fed was going to be cutting rates and longer term yields could creep higher on a relative basis. Are we looking at a reversal of that? The more that Fed officials talk about pausing and allowing this economy to run and taking their time finding neutral.
Yeah, it could slow it down. I do think steepening is still the logical outcome of what we're looking at because, normally you would have, 60% of the time, you would have the Fed funds rate about 100 basis points below the 10-year yield. And now, we're not there yet. And so as the Fed lowers rates, if they lower rates, you'd have 10-year kind of just sitting where they are, and that would be a reasonable outlook, and that's kind of our general outlook. But if the Fed goes much more slowly or stays here, that may be a signal that the economy is going to slow down more, financial conditions might tighten, and that actually might send us back into inversion. I don't think that's the highest probability, but it's out there.
When you think about next year and you're talking about the dimensions of all these policy proposals, how important is the sequencing for you?
Well, yeah, it is important. Our best estimate is that we get the tariffs first, and then we get some immigration, and then the tax thing is down the road. But in the meantime, we have the debt ceiling to fight over.
January 1.
Yeah, so we have to get through every hurdle. And I think we can deal with the tariffs if they're being used as a trade negotiation tool. If they're really widespread and as high as anticipated or has been discussed, then that might disturb the market quite a bit. But right now we're just concentrating on the debt ceiling, trying to get through that.
Working out how strong the appetite is for deficit spending next year is still pretty tricky. We've got the Tax Cut and Jobs Act of 2017 that needs to be extended. Then you've got things like tax cuts and tips, Lisa. Then you've got things like the SALT deduction as well. I'm not sure how far they're willing to go. I've seen very little sign of that whatsoever over the last few weeks. I understand it's early days and we'll find out more in the next few months, but certainly doesn't scream priority right now, that's for sure.
There is a sense of, I don't want to call it fiscal discipline, but a lack of willingness to be completely fiscally profligate among particularly the Senate Republican leadership. And that is where I'm looking. But it's across the board, pretty much, that you're seeing just on the margins a real eye toward the bond market.
But one or two representatives could tank this. What was Libby Cantrell talking about to us this week? Historically, this is one of the slimmest majorities they have in the House. So you have Congressman Lawler, who everyone's saying might run for governor. He wants SALT. If that's not in the package, well, he's going to be a no.
That's settled the bond market down, I think, in the past week or so. We'll see how this one evolves into next year. Kathy, it's good to see you.
Thank you.
Kathy Jones at Charles Schwab. I don't know if it's too early to say happy holidays yet or not. But we can
Why
do
not?
it.
Let's
happy
do it.
holidays. It's good to see you.
Christmas trees are out on all of the avenues.
Hey, Bramo, my tree was up weeks ago.
So I should have started calling
If I came on the
happy
show saying
holidays.
Merry Christmas, you would have criticised me.
Okay, true.
Merry Christmas. Coming up, David Leibovitz of JP Morgan Asset Management, Evan Siegerman of BMO, Nita Richardson of ADP, and Leslie Falconio of UBS. From New York, the third hour of Bloomberg Surveillance. Up next.
We continue to think that this is an environment of transformation rather than an environment of your typical cycle.
Rates are still meaningfully above neutral.
Not only do you have fixed income concerns, but in equities,
They're very expensive from a valuation point of view.
You still have those winners and losers, but I would say that there's more winners than losers these days.
We think you're set up for another double-digit return for next year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
It's quite a finish to 2024. All-time highs in the equity market, record highs on Bitcoin, more all-time highs potentially in store by the end of today. Futures just about unchanged on the S&P. We've had 56 of them through the year so far. On the S&P right now, futures unchanged. On the Nasdaq, unchanged as well. In 30 minutes, you get some much-needed economic data. This time, it's jobless claims. Jobless claims, we're looking for a number around 215K, basically in line with the previous week, a very, very low 213. You'll get some more Fed speak. We've heard from Chairman Powell this week already. Called it a strong economy. And the headline numbers so far look pretty decent.
They've been an upside surprise after upside surprise, which is the reason why the U.S. Economic Surprise Index is near the highest levels going back to April. But it's not necessarily coming with a reacceleration in inflation yet. And I think that that's the reason why people think that the Fed is going to cut rates in a couple weeks' time by 25 basis points and then basically say next year it's a black box and we're not going to say anything and we probably will pause.
Confidence is up since the election. Business confidence is up since the election. You see that in the Beige Book. Consumer confidence is up since the election. We've seen that over the last few weeks. Now it's about policy. It's about emphasis and it's about sequencing. And we've been saying that on repeat for the last few weeks.
We just heard from Kathy Jones, and she says they view the sequencing as tariffs first, immigration, then tax cuts. Well, what is that going to mean for record high after record high on the S&P 500? And when you talk to people, they say, yeah, potentially one of the biggest checks. Jonathan, you've said this. One of the biggest checks on Trump 1.0, likely going to be part of Trump 2.0, is the equity market. So the sequencing potentially have to change if he wants to keep the rip-roaring we're seeing in the markets, which isn't going to bode well for some of his policies.
Antitrust and regulation is a key part of this as well. We just got numbers from Kroger. And as a headline here, reiterating their commitment to closing the Albertsons merger. Does that get easier with the incoming administration?
That's going to be an open question. Right now, markets are treating it as though it will get easier, considering that Lina Khan may not be heading the FTC. I do just want to point out, this is quite the set of headlines because you do have them committed to closing the Albertsons merger to get bigger at a time where their third quarter sales came in a little light and they narrowed the forecast going forward just a little bit into a little bit of the downside. And you look at this and you wonder, pairing it with Walmart, pairing it with some of the behemoths, do some of these companies have to get bigger in order to compete in a real way when consumers are feeling okay, but not amazing and not willing to shop at all times?
That's precisely the argument that they've been making over the last few months, and it's falling on deaf ears with this administration, and we'll see if that changes in the coming months.
And whether there is some sort of immediate response to that, I will just say, if there is more of an acceptance of that, how much of a rush of M&A can you expect to see, given that this is the argument that a lot of places have been making for the past couple of years?
When it comes to antitrust, the two positions is the DOJ antitrust position. Jonathan Cantor will be out. We do have the name for that, and this is a J.D. Vance acolyte, the individual who said he thought Lina Khan was one of the few people, maybe the only one in the Biden administration, that he kind of liked what she was doing. When it comes to the FTC, for sure Lina Khan will be out. That is still a name we are waiting on to understand the economic personnel makeup of this administration. And while maybe they're going to be tough on tech, I imagine a grocery chain or a handbag operation, M&A deals, I think those are going to be able to fly through.
The Kroger right now in the pre-market is negative by something like 5%. Coming up this hour, we'll catch up with David Leibovitz of JP Morgan, with the S&P 500 on track for its best year in 5. Evan Siegerman of BMO as Eli Lilly clinches a victory in the weight loss drug market. And we'll catch up with Nita Richardson of ADP, reacting to jobless claims, which drop in about 25 minutes' time. And we'll look ahead to payrolls tomorrow morning. We begin this hour with stocks at record highs as investors look ahead to a 24 hours full of jobs data. David Leibovitz of JP Morgan embracing a risk-on mood. From a portfolio perspective, we continue to embrace risk, but have been increasingly focused on the composition of that risk. High-yield valuations are rich, and we have taken some gains redeploying this capital in small and mid-cap US equities. David joins us now for more. David, good morning.
Good morning. How are you?
Let's walk through that switch. I'm good. Why go from credit to equity? What's behind that?
So when we looked at the move in spreads following the election outcome and we came down to 265 and then 255 on U.S. high yield, we said to ourselves, we feel like this is a trade where the return potential has been capped. I mean, all things considered, a 7% yield to worst is nothing to shake a stick at, particularly with a third of the volatility of the S&P 500. But you're limiting your upside there. And given some of the things that you all were just talking about around deregulation, tax cuts, so on and so forth, we wanted to lean more a little into the equity side, one where valuations are more attractive than the Mag 6, but also where we think there will be a direct benefit from some of the policies that will come through starting next year.
Small caps, double-digit gains for the month of November. What is underpinning that move? What do you think are the big themes that people are getting their hands around?
So I think that there are a couple of things going on with small caps. First of all, small cap companies primarily finance themselves with floating rate debt. So the idea that the Fed is going to continue easing, probably not as much as markets were thinking earlier this year, but I do think that there are still a few more cuts ahead of us. That's going to help their profitability right off the bat. At the same time, you're looking at a nominal growth environment that may not accelerate from where we are, but should remain well supported, and that can help both top and bottom lines. And then finally, the third thing just being the underlying sector composition of that benchmark. You have a significantly larger weight in things like financials and specifically the regional banks, which if we get some deregulation in financial services, which does seem likely, they're going to be the direct beneficiaries of that trend.
So at this point, are you basically saying that equities look a lot better than anything in the debt space, even when it comes to riskier debt instruments?
So I think that it's a function of going underneath the surface in things like high yield. And when we put our overweight to high yield on earlier in the year, that was really predicated on the idea that CCC rated bonds would see significant spread compression. That's effectively what we've seen. That's what's driven the index level spread to such a low level. And, look, could we end up at 230, 225 at some point down the road? Absolutely. And we also recognize that when spreads are low and tight, they can stay tight for extended periods of time. But it feels like, particularly with some of the conversations around animal spirits, we just want to have more exposure to the upside than things like U.S. credit were really giving us.
Does it worry you that everyone's on the same side of the boat right now? I mean, honestly, person after person, everyone's talking about euphoria. They're getting even more risk on. How do we get even more risk on? Because honestly, we weren't as risk on as we probably should have been 2 months ago. When does it become a problem?
So the bulls are definitely on parade, but I think that the unique thing, and John Authers mentioned this in his note this morning, is you look around the world and where else are you going to go? I mean, the profitability of U.S. companies is unlike anything else that's available in the global equity market. Furthermore, and this is a point he made, 2/3 of the global equity market is the U.S. So if you have less than 2/3 of your portfolio in U.S. equities, you're effectively underweight what's been working so well. So that's not to say that there won't be a broadening out at some point down the road. But when we think about what's been discussed on the campaign trail and we think about what Trump 2.0 might bring to the table, it's not a long-only U.S. trade. It's a long-short trade. Long the U.S., short the rest of the world, because some of these policies, particularly tariffs, are going to be punitive for other countries.
Right. So the walls are going up and you want to be invested big in America. What do you make? You're talking about animal spirits. What do you make of what's going on in crypto right now and what's going on in Bitcoin?
So I think that there are a couple of things going on with crypto. One, I think that generally the risk-on environment has supported Bitcoin moving, north of 100,000. I think the other thing that's going on is that when you look at what's happening in the U.S., you look at what's happening in Europe, you look at what's happening in Asia, fiscal spending is very much a part of the conversation, whether it's China or Germany easing off the debt brake or what we're going to get here in the United States. And I think that this reflects some concern that over time government spending could go too far. So it's not a different conversation from the one that we've had, over the past 10, 15, 20 years, the debt's too high, the deficit's too big. But at the end of the day, if you're seeing this, another way that people can play that through their portfolios are through things like crypto. So they arguably just have a different lever to pull than they did a decade ago.
Is now the time to put some money in places like that, and gold and Bitcoin?
So, I mean, the trend can be your friend for an extended period of time, and momentum investing has certainly worked well in 2024. Frankly, I would be a little bit cautious there. I think a lot of this is going to come back to what the Fed does in 2025. And we do think that the Fed will cut again in December. I think that they probably fall into a quarterly cadence in 2025, and maybe we get one or two. But then you're looking at U.S. rates that are still fairly attractive. And I think, some of the Bitcoin and gold continuing to rise, some of that, again, is dependent on rates coming down. And I'm just not sure that the people who are buying those assets, particularly in the retail world, have an appreciation for where rates may stop.
Bitcoin is rallying this morning. Here's another thing that's making a move higher. American Airlines with a big rally of the pre-market off the back of this. Their outlook for the fourth quarter. Here's the range now. 55 cents to 75. The previous range, 25 to 50. We're higher by 7.6%. Lisa, it's not just them. It's Southwest, it's American, it's JetBlue. Yesterday we talked about that. The airline business into year-end looking better than expected.
Yeah, Southwest raising their revenue forecast because of the demand in travel. How much is this payback because of the post-election certainty? Just there is a president-elect, and so therefore people can travel. Still try to explain that to me. I can't figure that out, but that's where we're at. What I think is interesting is also you see how some of the initiatives are paying off. With American Air, they've solidified their relationship with Citigroup as their sole credit card provider and are trying to get that alliance because all of these airline companies are really credit card companies. And then with JetBlue, they're trying to cater to a higher end customer, and that's paying off. So a lot of strategy shifts that are paying off at a time where everyone wants to travel.
Is consumer confidence back, David? Is it booming post-election?
So I think consumer confidence is coming back and could well continue to improve. But I come back to the fact that for a lot of people, inflation is still an issue. And it's not necessarily about the annual rate of change. It's about the cumulative inflation that we've seen over the past few years. If you think of common man inflation being food, energy, and housing, I mean, that's well above what you're seeing the headline CPI index at today. And so I think it will come back, particularly if we get tax cuts, particularly if we get some deregulation and markets continue to rise. But the inflation issue is one where I don't think we can signal the all clear, at least not quite yet.
That certainly speaks to the political shift in this country over the last month or so. David, it's good to see you. Great to catch up. David Liebowitz there of JP Morgan. American Airlines up big time in the pre-market. Equity futures still just about negative by not even 0.1%. With an update on stories elsewhere this morning with your Bloomberg brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. The search continues for the man who allegedly shot and killed United Healthcare CEO Brian Thompson. Police say that Thompson was specifically targeted in the attack, but they do not yet have a motive for the shooting. Thompson's wife said that he had received threats before he was killed. Police are offering $10,000 for information on the case. Elon Musk and Vivek Ramaswamy are headed to Capitol Hill today to meet with Republican lawmakers to discuss plans to slash at least $2 trillion from the federal budget. The two co-heading a new outside advisory body created by President-elect Donald Trump to cut costs. According to the FT, venture capitalist Mark Andreessen has been helping to recruit candidates for the so-called Department of Government Efficiency. And in sports, Liverpool were held to a draw against Newcastle despite 2 goals from Mo Salah. The Premier League's top team surrendered a tying goal in the 90th minute. The draw limits their lead over the second-place Chelsea to 7 points. Elsewhere, Arsenal defeated Man U 2-0 at Emirates Stadium, helping to close their gap behind Liverpool. The match marked United's first loss under the new coach Ruben Amorim. And that's your brief, John.
And that's why we did that in the brief, because Manchester United lost. Just for anyone who's wondering, because if you're a Liverpool fan, you might be wondering, well, what about every time we've won? Why haven't you talked about it? We drop points and it gets a mention.
Okay, honestly, now they're only a 7-point lead. Ooh, people are really concerned about them. I think they have to lose 2 more games to not win the whole thing or something of that nature. I mean,
that was amazing. Mohamed Salah's spin goal.
The guy needs a contract. What is going on at your football club?
The Egyptian magician?
Yeah.
I don't know.
Get the man a new contract.
What do I know about this stuff?
What's happening there? Up next on the programme, we blame you, Bramo, for everything.
Great.
The Morning Calls, plus Evan Siegerman of BMO. As the weight loss drug battle between Eli Lilly and Novo continues to heat up, as we count you down to the opening bell, about 1 hour and 15 minutes away, with equity futures here just about unchanged. Ahead of jobless claims in about 15 minutes' time. So we're getting closer to the weekend. You can tell I want to get to the weekend. We're getting closer to the weekend. 8:30 Eastern Time, jobless claims, so 14 minutes from now. And then tomorrow morning, it's all about payrolls. There is no other story. Going into that, equity futures just about unchanged on the S&P 500. No drama throughout the morning so far on the equity side. Plenty of drama for Bitcoin. Another all-time high. In the bond market, yields bleed a little bit higher by 2 or 3 basis points. We're up to 420.51 on a 10-year. Let's get you some morning calls. First up, Citi raising its price target on Netflix to $9.20. citing more confidence in the company's advertising tier. That stock is higher by around about 0.1%. Your second call from Morgan Stanley, downgrading Applied Materials to underweight, saying the weaker operating environment for markets in 2025 will lead to a correction. That stock is down by close to 2.5%. And finally, Bank of America hiking its price target on Tesla to 400, noting confidence in EV growth and robo-taxi capability. The rally continues. We're up another 0.7% in early trading. Let's turn to pharma. Eli Lilly's weight loss drug Zepbound outperforming rival Novo Nordisk's Wegovy in their first head-to-head trial. Even Siegerman of BMO saying the results were expected and could fuel modest commercial growth for Lilly as both companies focus on the next generation of obesity drugs. Evan joins us now for more. Evan, welcome to the programme. Let's get to 35,000 feet if we can and just talk about the adoption of GLP-1s. Seems to have gone quiet over the last 6 months or so on our side. I'm sure in your world it's still very busy and quite noisy. Can you talk to us about the adoption and whether things have slowed or whether you're still seeing that really steep growth that we saw over the previous year?
Sure. So let's go back to 3Q results because that's where we saw a real bifurcation between Lilly and Novo. So Lilly indicated that they have enough supply. They're trying to drum up some demand, aligning with what you just described. Novo, on the other hand, still has some supply issues with their assets like Wegovy. So they're still working through that to meet this demand that they're seeing in key U.S. markets. You know, one thing that I want to highlight, let's talk about the Surmount 5 data yesterday. That was largely expected. We know tirzepatide Zepbound is better than Wegovy, but now Lilly has that data. They can go out to physicians and say, yeah, ours is better. What's really important, though, and I'm sure we'll talk about it, is Novo has a data readout by the end of the year called CagriSema. This could be better than Zepbound. And people were kind of skeptical on this because it was going to have to be delivered in a dual-chambered pen. But yesterday, we found a trial posted on clinicaltrials.gov, which is the website for clinical trials, showing that Novo may have cracked a co-formulation of the asset. So a lot of moving parts, very exciting. I think fourth quarter will be very important because these companies got beaten up in 3Q and hopefully will turn the tide for a stronger 2025.
Evan, when you say it's better than Zepbound, what's better about it? Delivery, performance? Is it more effective? What is it?
Great question. So weight loss. So analysts and investors are looking for weight loss of at least 25% of one's body weight by the end of a year. Zepbound does about 20%, so that's about a 5% delta. I know some investors want to see more than that. On the tolerability perspective, it should be in line with what we see with Zepbound. It might be slightly worse because you do have another drug in there, but it's that weight loss component is what we're really focused on.
Evan, how much is the real barometer, how much weight you lose and how much is it, you call it tolerability, not having a miserable life, not feeling like you have to, that you can't eat, just to put it that way. I mean, how much are you measuring this?
So that's very important because you are correct. When you are taking these products, you don't want to be nauseous. You don't want to have GI issues. Those do subside after time. They're usually associated with what's called the titration, so increasing the doses. But again, if you're doing that for 6 months, you want to feel good. So we do look at that tolerability profile. It is very important. But at the end of the day, it's that weight loss because folks, you don't just want to hit 12% if you really need the weight loss. You want to get to that 20-25%.
How much is the success of one drug or another contingent on the insurance profile? And we've heard about President Biden talking about how he would like to see weight loss drugs covered under certain government insurance programs. Is that sort of one of the key variables with some of these studies and the success of one drug or another?
So insurance coverage is obviously very important. For what it's worth, Lilly and Novo have pretty good commercial insurance for Wegovy and Zepbound. So that's insurance through, say, one's job, not Medicare. I think that's the X factor that you're getting at. Biden, I believe, last week or the week before had a memo out essentially suggesting that Medicare should cover these products for patients who are eligible and not just for something like a cardiovascular disease or potentially sleep apnea, which Lilly will have on the label by the end of the year. So I think that's very important because there are a lot of patients who are in Medicare and Medicaid who could benefit. That could be a nice tailwind, assuming that happens. Of course, there is some expense associated with that. I mean, we'll see what happens when you have a regime change next month.
Right, and RFK Jr. is an outspoken critic of these drugs, especially when they're used for weight loss. So how do you see potentially that proposal maybe being used or just totally dismissed by an incoming Trump administration?
This is getting complicated. Well, a few things. One, RFK won't be head of the FDA, which is good. Number two, these decisions are made by HHS, so that's Dr. Oz. I don't know what his exact views on GLP-1s are, but he seems to be a little more farmer-friendly, still a skeptic. I think what's key here is if the Biden administration can get this on board now, it's very hard to take away things from seniors once they have them. That's not very popular either. And remember, President-elect Trump is focused on his popularity as well, not just, satisfying someone like RFK.
Right, but he's also focused on cutting government spending. And we're going to see that take place today when Elon Musk and Vivek Ramaswamy go to Congress. And this would cost taxpayers, according to the CBS report, as much as $35 billion over the next decade. Do you really see? Drop in a bucket, maybe, but they're looking at anything to cut. Elon Musk is talking about $2 trillion in spending. So why would they add on something additionally that was teed up for them by an outgoing Democratic administration?
So a few things there. One, it's a drop in the bucket of what we spend on pharmaceuticals, $800 billion, $5 trillion in healthcare. I hear what you're saying, most definitely. I think what's key here is you actually get a lot of savings because you're saving elsewhere in the healthcare system, assuming patients are on these drugs for, a couple of years, 5-10 years in Medicare. You're spending less elsewhere in Medicare. I'd also highlight that a lot of this is paid for by premiums in Part D, right? Part D is funded a lot by premiums for enrollees. So there is a government component, but it is some cost sharing as well. So yes, clearly, Elon Musk and Vivek Ramaswamy want to cut government spending. But remember, cutting Medicare and Social Security, very unpopular. Again, going back to my earlier point on President-elect Trump's popularity.
Evan, just to sort of finish where we began, we talked earlier this year that GLP-1s would change the trajectory of equity markets and, frankly, of the healthcare system in the United States, that it would change the trajectory for food companies that would be selling less, given the fact that people had lower appetites. Why has that story gone away?
So I don't think the story has gone away. I think that there has been a bit of the wind has been taken out of the sails, shall we say. 2Q was good for Lilly. 3Q wasn't great. I need to see a good 4Q, and I need to see really positive momentum into 2025. I think that a lot of the low-hanging fruit, to use a terrible cliche, has been kind of picked already. So now Lilly and Novo need to go out there and continue to build the market. We're still looking at over $50 billion in sales for these products across obesity and diabetes for 2024. So it is still a very large opportunity and growing. So I think investors are always looking for what's next and what's hot, but this is still here in my view, and we need to see good posturing from these companies for 2025.
Evan, this was great. I enjoyed this. Thank you, sir. Evan Siegelman there.
Thank you, guys.
BMO on the latest. Thank you, sir. 40% of this country's obese. It's an uncomfortable conversation. You've got someone disruptive coming into the government who wants to talk about the causes and not just the symptoms. Look, I know that the negatives have been covered a lot for good reason. But there are some positives here. You need to disrupt this story. It's a story ripe for disruption.
You're talking about RFK Jr.
I'm talking about obesity across the board in America.
And what's going to cure it? I think that's sort of the discussion. Is it going to be going after food companies? Is it going to be promulgating the use of obesity drugs? Is it some combination of both? And is there the political will to have an honest conversation about what measures are necessary on a mass adoption scale? I think that's an important conversation.
The question is whether or not the Trump administration is going to take up this proposal. And it is going to cost money. I understand Evan's point there. Maybe you put the money in now and it'll save savings of potentially people that are obese and need help and that are relying on the Medicare system. Regardless, though, it's a proposal from an outgoing Biden administration.
I know.
It's going to be challenging, I think, politically to pick up.
Let's focus on the incoming administration. Congratulations, Bitcoiners, from President-elect Donald Trump. 100K, you're welcome. Is that a message?
You're welcome. He says together we'll make America great again. Well, I guess he's making Bitcoin great again.
Bitcoin approaching 103 through 103. From New York, more data up next. So we are 60 minutes away from the opening bell, with equity futures at the moment just about unchanged on the S&P, on the Nasdaq 100. In the bond market, we're shaping up as follows. Following comments from Chairman Powell yesterday, who suggested once again this economy looks strong. We'll get some data in just a moment that might speak to that. Jobless claims just around the corner. Yields are higher by 2 basis points, in and around 420 on a US 10-year. On a 2-year, up by 2 basis points to 415.23. With your economic data this morning, let's get across to Mike McKee. Good morning, Mike.
Good morning, John. A bit of a surprise in the jobless claims numbers, up to 224,000 from 215, basically a slight change up to the week before. There was a downside risk to numbers this time because last week was Thanksgiving. And so maybe some of the offices or people who were unemployed didn't get out to file. So we'll have to put this one aside in terms of a real strong signal on the economy and say we'll check into it next week or the week after as we continue on into the holiday season. These numbers get a little less reliable. Continuing claims fall 1,871,000 down from 189.6. So we're seeing some progress on people getting jobs. And the trade balance, $73.8 billion, significantly lower than the previous month's $84 billion. Well, 83.8 is the actual number. And it is lower than the anticipated number from the advanced numbers. So that is good news for fourth quarter growth.
Mike McKee, 215 is the estimate for tomorrow morning. We've been asking this question for the last couple of days. How strong is strong? Is 250 strong? Does it need to be bigger than that, given the bounce back we're anticipating from October?
I don't think any one number is going to move the Fed one way or another because they know there's going to be a bounce back and it's a little bit hard to track. Watch the unemployment rate, which isn't affected by the hurricanes or the strikes. That will be more telling for the Fed. If we get a really big number, you'll get a market reaction. And I've seen estimates as high as 300,000 or more because nobody really knows how to quantify the impact of the storms. Although we did see state employment figures for the month go down in the 5 states that were affected. So it's going to be an interesting number, but not dispositive. I think you got to look to CPI and PPI next week for more of a clue.
Mike McKee, thank you. Small upside surprise on jobless claims here, 224. The estimate was 215. Going into tomorrow in our survey for the headline payrolls number, we're looking for 215, a big bounce back from that very small 12K for the month of October. With us around the table, Nita Richardson of ADP. Nita, good morning.
Good morning.
Good to see you. Good to see you. What did you notice about the ADP report? What was the big takeaway for you and the team?
Well, it was a healthy amount of job growth, but it was mixed. We saw a lot of weakness in manufacturing, and according to ADP numbers, dropped 26,000. That's significant. And also we saw some softness on the services side, too. Things that had been strong, like leisure and hospitality, took a step back, just 15,000. Financial activities, you think they're positioned for all this merger and acquisition activity to come with lower rates. Again, hiring was lackluster in that sector. Large firms did the bulk of the hiring. We're used to seeing small firms outperform in certain areas of hiring. At least that's what happened in the recovery period. Now large firms are really basically owning the jobs market. And then the final thing, and this is the most important when you're looking at the Fed, wage growth went up. It went up. So that suggests a still tight market.
So you've got to tell me, given everything you said before the last bit, what's driving wages higher?
Yeah, so there's a tightness in the labor market in key sectors. It's not all growth. Remember, at ADP, we match individuals with themselves. So we're not as shaken by permutations in the labor market from month to month. These are people who have been in the job market over the course of the year. And for those people, they are seeing an uptick in their wage growth. The catch here, and this is important, is that it's still not keeping up with inflation for the average worker.
Yeah, but you said there are key areas of inflation. What are those areas at a time when I remember you said that statistics professionals were really in vogue as a lot of businesses tried to understand how to use artificial intelligence and where to invest? What is it now?
Well, first of all, it's long-term trends, which means healthcare. I just read that like 10,000 people a day have a birthday that takes them over 65 to 65. And so we are a retiring community. We are a retiring country. And in that retirement, we need healthcare because, health issues become more intense as you get older. So that sector is growing. And who would have thought that healthcare would be the outperforming sector? If you're looking at the labor market like the stock market, that is the value stock. It's healthcare. The growth stocks are not performing as well. So when you look at that statistician, information technology, when you're looking at professional business services, they're not growing as much. I think what we're seeing is that there are some emerging fields. I think energy and technology together are going to create a huge burst of job opportunities, but they're not flowing through the labor market quite yet.
How vulnerable do things feel to you? I mean, I ask this because a lot of the data is messy. I mean, we just got jobless claims ticked up a little bit. It's hard to know exactly how accurate from month to month some of this data is. There was a pretty big revision in the prior month, even in the ADP numbers. Are things feeling messier to you or less specific, or do you feel like you have a pretty good handle on things?
I think there's going to be two head fakes. One was in October, when we saw that really small number because of strikes and hurricanes from the BLS. The second head fake will be tomorrow. You're going to see a bounce back that won't tell the whole story of the labor market. The story of the labor market is that we're in a quiet period. There's not a lot of layoffs and there's not a lot of hiring. We're in this kind of stasis period. How long that quiet period lasts is undetermined. And what triggers it and which way, whether it goes up or down, still undetermined. So yeah, we're in a messy spot. I think you still see positive hiring that is healthy and can support this economy, but we're lacking the dynamism that really pushes us into the next century in terms of new technology. So I'm still worried about productivity. I'm still worried about softness in the labor market in key sectors like manufacturing.
Well, let's pick up on manufacturing. Donald Trump is talking about tariffs. He's already negotiating with the likes of Canada, potentially, about what those tariffs may look like on China, on Mexico. Is tariffs going to help the U.S. manufacturing base, or is it going to hurt?
That is really too soon to tell. Because, first of all, we should take a step back. Economics is not immutable. It's not like physics. It depends on the context of the economy, and it depends on the retaliation of the people of other countries. So we don't know, and we won't know for quite some time. But it will depend on whether those tariffs are placed on final goods or intermediate goods. It's really hard in a global economy to have a purely domestic manufacturing supply chain. And for those manufacturers that require and rely on foreign goods, that's going to increase their costs of production. So we're going to have a pretty unclear, muddy picture of what that looks like. But one place we can look is in the jobs data. If you see manufacturers hire, if you see a rebound in this very cyclical sector that should benefit from rate cuts and maybe will benefit from well-placed tariffs, who knows, then we should see a pickup in hiring, and that's what I'm looking for.
Always smart. Nita, it's good to see you. Nita Richardson there of ADP. Nita Richardson, also, of course, a Bloomberg TV contributor. Looking ahead to tons of Fed speak. You'll hear from Barkin today, tomorrow, Barman, Goolsbee, Habak and Daly as well, of course, looking to their reaction on a payrolls report. Mike McKee's back with us. Mike, we heard from Chairman Powell. Walk us through what we have heard from Fed officials so far this week and what to look for going into the quiet period.
Well, a lot of holding our options open talk, John. They're trying to, at this point, set up for data that they don't have yet, but the markets will have by the time the Fed is meeting. They go into their quiet period next week, so they can't comment on CPI or PPI. But what they're saying is basically the economy is stronger. We've seen inflation sort of stick higher than our target and hasn't been moving down in the same way. But overall, the economy is in good shape. So we don't have to move if we don't want to. They all then add that we want to bring rates down some. So they could go either way depending on how the data go. But I think one of the more interesting aspects, and this is something that Neela touched on here, is companies sitting on the sidelines for right now. And the Fed knows that because they're talking to all the CEOs. Companies don't want to make decisions on hiring, on investment, until they know what Donald Trump's plans are going to be. So this is going to be something of a quiet period. We get a rebound in jobs for November just because of the strikes and hurricanes. But do we see a lot of new hiring? That's going to be a really interesting question for these couple of months in between now and when Trump takes office.
Michael McKee, thank you, sir, on a Fed speak and on the economic data. With us around the table, Leslie Falconio of UBS. Leslie, good to see you.
Thank you.
Let's get into your expectations. So this is what you're looking for: healthy consumption, loose fiscal, lower rates. Did the first two challenge the third?
Actually, we don't think so. I mean, we're looking for lower rates, but not something that is dramatic, because we're still looking for the soft landing. So we do think the consumer is strong. We think the labor market stays strong. But our outlook for interest rates in 2025 has probably fallen about that 4%. So when you think about where we are right now, it's not as though we're expecting this, large decline in interest rates. But, one of the things that we look at when we have these allocations and the risk to the market that I know all of you have been talking about is if, in fact, the Fed does continue to cut and people are concerned about this inflation, right? The market has a tendency, particularly fixed income, to speculate, right? It's forward-looking. So if the Fed cuts and we have interest rates move higher, I think that's the point of concern, particularly when you now have a market that has, the equity and the fixed income market returns are now negatively correlated. If that's due to inflation and the interest rates move up and they decouple, that's when you're going to have these price-sensitive buyers kind of get a little bit concerned about that long end and really require more term premium.
What did people get wrong heading into the election about Republican policies that sound like they're on track, being inflationary? And now people aren't really talking about it as though they will.
I think, it's funny, last time we were here, we were talking about what the market was pricing in, given the fact that the betting markets really had, made the decision prior to the actual election. And one of the things that I spoke about was that, the expectation was if, in fact, you had this red sweep, that you'd have this bear steepener at first, but you should push against it. Right. And when we talked about what we saw in November, we've seen interest rates come down. So I think a lot of that was priced in, particularly when you look at things like inflation expectations in the short end, decoupling from oil coming down. So all these kinds of things were priced in. You've given a little bit of that back, but I think it's too soon to say that things like short end inflation expectations are going to continue to decline. I think they will probably stay where they are now and even maybe have the potential of moving up in the near term.
Do we have we reached a point where the labor market is no longer the barometer to look at, that it really is back to the inflation reads at a time where that is the one lever that could potentially push the Fed in a much more aggressive way to hold off on rate cuts or potentially even move in the other direction?
We've had this changing narrative for quite some time, and I do think, listen, I think it's balanced. I don't think you do not look at the labor market. You do. But, the labor market has continuously been strong. I mean, we have, when you saw the JOLTS data, you had the quits rate up for the first time since, 2023. We have, the claims a little bit higher today, but still trending lower. But I think people are just really worried on that inflation front, particularly given the fact that we are, and it's our expectation, too, that the Fed cuts in December and it goes, 4 times in 2025, that we have this sort of reacceleration. And I think that's really what the focus is right now.
So we had David Leibovitz of JP Morgan on earlier, and he said that earlier this year they were very excited about high yield bonds because they expected a compression in the lowest rated debt spreads. Now they're kind of done with that. They kind of see that trade's over. Are you in the same place?
Absolutely. I mean, when you look at high yield bonds at 260, 265, that risk premium is incredibly compressed. And as you pointed out, this has been led by the CCC sector, which has come down. But what's interesting about that sector, you've had such a high demand, within that sector for those yield-hungry investors, right? But even as volatility went up, it hasn't gone up lately, it's actually come down, but when it was rising, spreads were very, very narrow. So you really didn't see a lot of widening in that sector. So we do think high yield is a bit on the rich side, and we really prefer the higher quality. You have that yield, there's no question, but the risk premium that you're being paid just isn't adequate right now. With that said, if the opportunity arises that high yields widen out, we would be opportunistic. Because we don't think you're going to be a recession, or we don't think spreads are going to, move materially wider.
Do you think that this is basically the message right now heading into year end? You go with what's worked. You don't really do much else. You kind of sit on your hands. You wait for momentum to lift, and then you reassess next year when you actually get policies. Is that kind of where everybody is right now?
Those that are making money. Yes, I think so. But yeah, I do think that is really sort of the overall. I think that right now people have been in the camp where, the market has been very volatile. The market is, as the MOVE index has gone up and down, we've had a lot of, changing of narratives. But I think now to the end of the year, people just are tired of this, really the speculation. You really need to wait to see the policy, what the policy is going to be. And, I think you've had the have and have-nots this year in terms of people being right and wrong on the side of whether it's equity or fixed income. But I do think it's going to be a little bit quieter at the end of the year. And the first quarter is going to be incredibly important, but it's really going to be the second half of 2025 when you get that data that's really going to lead.
Leslie, it's good to see you and great to catch up as always. Thank you. Leslie Falconio there, of UBS. With an update on stories elsewhere this morning with your Bloomberg Brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Sources told ABC News that a search warrant is being sought in connection with the suspect wanted in the fatal shooting of United Healthcare CEO Brian Thompson. Sources also telling ABC that police appear to be closing in on the identity of the alleged shooter. Thompson was shot around 6:45 a.m. yesterday outside the New York Hilton in Midtown. Police are offering $10,000 for information on the case. And Kroger shares this morning are off the low, still down about 0.5% in the pre-market. It trimmed its annual outlook, posted third quarter sales that missed expectations, all pointing to an uncertain economic environment. The grocer did, however, reiterate that it's confident that regulators will approve the acquisition of its rival Albertsons. TikTok tripled its U.S. shopping sales to over $100 million. The company said its app drew a 165% annual increase in shoppers for the 2 days between Black Friday and Cyber Monday. This comes as the app faces a potential shutdown in January as regulators fear its parent company, ByteDance, poses a national security threat. And that's your brief, John.
Danny, thank you very much. Up next on the programme, we'll set you up for the day ahead and bring you an exclusive conversation. Francine Lacqua sitting down with Marine Le Pen. That conversation up next. The opening bell about 41 minutes away. Equity futures right now negative by 0.1%. The S&P on a 4-day winning streak coming into Thursday. A little bit lower on the Nasdaq as well, down by about 0.1%. Let's turn to France, where French President Emmanuel Macron is searching for a new prime minister after lawmakers passed a no-confidence motion. Bloomberg's Francine Lacqua sat down with National Rally leader Marine Le Pen and asked her if getting the deficit to 3% of GDP in 2029 is far-fetched.
Getting to 3% in 2029, I don't think it's credible, but I'm not the only one. I don't think it's credible either to the President of the Cour des Comptes. Once again, these are simply promises, and they know very well they can't keep to them. Mr. Barnier made this promise, and in reality, his budget worsened the deficit by 12 billion. So, if we don't make significant, intelligent structural savings with regard to the state, and if we don't put in place the conditions so that companies can work, invest without being suffocated with extra taxes, we won't get there. But with these two solutions, we can succeed as quickly as possible to get back to a reasonable deficit, even if the 3% was just decided on the back of an envelope.
How fast could that be? C'est l'affaire de quelques semaines.
Well, it's a matter of a few weeks. We'll discuss it with the new Prime Minister. We'll work together. We'll explain what our red lines are. Our red lines are we can't ask the French people to pay the bill for the mistakes of their leaders. That's what Mr. Barnier did. He massively increases taxes, he hits sick people, retired people, he hits everyone. And at the same time, once again, there's zero savings from the state. That's inadmissible.
Joining us now, the brilliant Francine Lacqua. Francine, once again, wonderful work as always. Walk us through your big takeaways and what you think the next steps are after speaking to Marine Le Pen.
Well, John, first of all, we have to see who President Macron, of course, appoints as prime minister, whether she will be behind him. Now, she was very clear in that interview is that it doesn't matter for her. She says who's prime minister. What matters to her is what points they want to push through in the budget. So we need to watch out for three things. First of all, the prime minister, he could be nominated as soon as tonight. It could take weeks. We know that President Macron in the past has taken his time. Two, what kind of thing will she support for the next budget? So she says that they will find a way forward next 2 weeks so that there's no government shutdown come January 1st. What happens after that? Are we going to be in political limbo and crises with prime ministers falling until the legislatives next summer? And then the third question is, of course, what happens to the presidential election? There's a big call. I think the latest poll is 54% of French now want President Macron to resign. What does that mean? Marine Le Pen is also facing trials that could make her ineligible to become president the next time round.
There's also this point, Francine, that she made, that Le Pen made, that essentially there is no case for Emmanuel Macron to quit under current conditions. Francine, it seems like that was a pretty considerable statement, considering that some people were wondering whether she was going to push him to resign. What comes up? What's the implication from that in terms of her willingness to work with him?
Well, first of all, she was very careful, Lisa, in saying that she would not push him to resign. She also, I tried to understand whether in his position she would have resigned. I think she's trying to strike a tone of being conciliatory, of trying to work within the institutions. But I also asked her what it would take. I mean, remember, she did very well in these legislative elections. 11 million people actually voted for her party. So I asked her what it would take for Emmanuel Macron to keep some of the promises that she thinks he should uphold because of these legislative elections. And she said, well, if that were the case, he should resign. So she's not pushing him to resign, but I'm not sure there's a way that they would work together, again, hand in hand.
Francine, a fantastic conversation. Looking forward to watching the whole thing. Bloomberg's Francine Lacroix sitting down with the National Rally leader, Marine Le Pen. Of course, you can catch that full conversation online at Bloomberg.com and on the Bloomberg terminal a little bit later on today. The euro settling down, stronger today. French credit spreads or French sovereign spreads, a little bit tighter over the last 24 hours as well. Things have calmed down, Lisa, just a little bit on the market front. On the political front, we are deep into the unknown.
Yeah, we're deep into the unknown at a time where, as you just heard from Francine, Marine Le Pen might have been maybe offering a conciliatory tone, maybe not. Nonetheless, there also was this bit of news that came out a bit earlier, I believe in the Financial Times, that European countries are discussing a 500 billion euro joint project for common defense budgets. So there are other things that are coming around as maybe there's a bit of a fire lit in certain sectors in the European area.
If you are just joining us, welcome to the programme. We are, of course, counting you down to the opening bell, about 36 minutes away. Equity futures at the moment just a little bit softer on the S&P 500, down a tenth or two across the board. No real drama here in the equity market. With some morning movers, let's cross over to Manus Cranny. Good morning, Manus.
Jonathan, good morning. I'll give you a little bit of drama in the crypto world. Bitcoin through $100,000. The personification of the beneficiary. I chose Coinbase, a number of different reasons. I mean, this stock is up 70% since the election, Jonathan, but it's about what does Paul Atkins, the proposed new SEC chair, do for crypto? This universe is up by $1.3 trillion since the election and counting. Roll it over, have a look at synopsis. The personification of what happens in a software company when you're delivering into the AI world and to the semiconductors. It is a tale of two markets, according to the CEO. They design the electronic automation software. This is a tale of two markets, they say. The AI build-out, we know this, is rocking. It's the rest of the semi-world, which is, in inverted commas, doing fine. Doing fine is just not good enough. We know that in terms of the narrative for guidance. And they're guiding down to 11.5% to 12.5% growth in revenue. And that tails from 15%. I leave you with 5 below, Jonathan. Banging away, up 15%. This is about a new CEO, Winnie Park. Can she deliver the marketing know-how to drive this through? Apparently, the season is off to a pretty good start in terms of the numbers as we go into the holiday season. Jonathan, good morning.
Manus Cranny, good morning for the 5th time this morning. Thank you, sir. Appreciate it. Going into the opening bell, about 35 minutes away. Here's the trading diary. Here's the calendar. The next 24 hours or so. Richmond Fed President Tom Barkin speaking at 12:15 p.m. Eastern Time. After the closing bell, earnings from Victoria's Secret and Lululemon. Lulu, of course, a big focus for Bramo. So looking forward to breaking down those numbers tomorrow morning.
Maybe I'm going to move on.
You're going to move on from Lulu?
No, I don't know. We'll see. I don't know.
Okay.
I think that there are a couple other brands that are kind of in the running right now.
Team Vuori.
Yeah, look, it's true. All right. I do wear my workout clothes to work so that I can.
That's not where I was going with this at all. That's really not where I was going with
this. So that I can run home.
You always talk about the brand. All right, let's leave this. Tomorrow, UMich sentiment and a big one, November payrolls. Looking ahead to next week, Wednesday CPI, Tuesday PPI and an ECB rate decision. Coming up tomorrow, fantastic lineup. Tune in. Laurie Calvasina of RBC, Priya Misra of JP Morgan, Torsten Slok of Apollo, Mohammed Al-Erin of Queen's College, Cambridge, and a whole lot more. From New York, thank you for choosing Bloomberg TV.